What moves the market is uncertainty. Tariffs are certainty at this point.
The marketplace has absorbed the idea of a 10% plus or minus tariff. The market has absorbed that and moved on.
The markets might overreact between now and September, October.
You're guessing what the center of the economy is. Overall, the consensus looks like to wait and see.
What we're looking at is probably a little bit more risk of a melt up.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Heading into the weekend, just short of all-time highs. A mega-cap tech-driven rally helping to send stocks towards record highs as Treasury Secretary Scott Bessent pushes to strike down the so-called revenge tax, and Commerce Secretary Howard Lutnick primes the market for a bucket load of trade deals.
I think we have deal after deal after deal. The president's going to make his call. And then what we're going to do is we're going to lay out a structure of all the different kinds of tariff arrangements. We're going to set that all up and get that ready for July 9th.
And this equity market keeps grinding higher.
This year has been an exercise of tail risks being put on, tail risks being put off. And essentially, you said it best a while ago, John, when you said if you went to sleep on February 19th and you woke up right now, you basically would be in the same place that you were then. Things in the Middle East have calmed down. You're getting news of trade deals. It looks like the Congress members are bickering, but they're going to get some sort of deal done. Yields are lower and the economy isn't cracking. Kumbaya, it's Friday, and that's the mood that we've got this
There's
morning.
a lot of hopium, isn't there?
There's a
lot of hopium coming into July next week, for July 4th, for July 9th.
The timeline is so short right now, and the president even acknowledged that yesterday, saying I hope we get the bill by July 4th. That is 1 week from now to get this one big, beautiful bill through the Senate. It is still with the parliamentarian, who already is striking down some measures. It hasn't even gone through the entire provisions of it and the analysis of it. Then it needs to go back to the House, and they need to decide if they're going to fight with the Senate or swallow some of those changes. And then it's a week and a half to July 9th. So where are all these trade deals? There's a bucket load. Where, with who? Where are they? Are they going to have to extend the deadline out? And I think they are, based on some of officials on the other side of the table negotiating with Ambassador Greer and Treasury Secretary Scott Bessent and Howard Lutnick, that they're probably going to have to give some of these countries a little bit more time.
This stock market has moved on really, really quickly. This stock market on the quarter, a quarter that closes on Monday, the S&P 500 is higher by more than 9%. This is a quarter that includes April. Think about the fear and carnage after April 2nd for the next several weeks, and we've recovered from that and some in a pretty aggressive way.
So I was looking at data from DataTrack that showed that the NASDAQ 100 has seen the third fastest decline of 20% and then rebound of 20% to record highs in a really short period of time. It's been 85 days for this round trip. It just shows how sentiment's been driving everything. And I was thinking, I don't know if you know that advertisement, wax on, wax off, but it's sort of tail risk on.
Isn't that Karate Kid?
Tail risk off. Yeah, okay, then but it was also an advertisement for wax.
Back to the movie from back in the day.
Yeah, so it was like wax on, wax off.
I've got no idea where you're going with this.
Tail risks on, tail risks off. And it's sort of like, is the threat of potentially the tail risk being taken off enough to allow this market to go substantially
Mr. Miyagi, right?
Yes. Repetition,
right? Yes.
I mean, you can learn a lot from the Karate Kid.
Yeah, we have to go there for today's market.
Let's go back to the all-time highs. So this from Michael Harnett of Bank of America this morning, really zooming in on the lack of participation here. This record high that we're very, very close to and will probably look for at the opening bell, only 22 S&P 500 stocks currently at record highs.
Yeah, what's old is great again, is new again, and that's really the big tech names that have been driving this, and it feels like that is going to be the leadership going forward. As so many people say, okay, now that we've worried about all of these things, we can now focus once again on the AI predominance that continues to drive earnings, both for tech companies and for the adopters.
We had some weight to the rally this morning. The Nasdaq 100 up another 1/3%, up a quarter on the S&P. Coming up this hour, Jim Bianco of Bianco Research with stocks near record highs. Tobin Marcus of Wolfe Research with the US and China striking some kind of an agreement. And Neil Dutta of Rudnick counting down to key inflation data and potential changes at the Federal Reserve. We begin this hour with stocks approaching record highs as investors quickly move on from trade worries. Jim Bianco of Bianco Research pushing back, writing on X the following: I share Powell's worry about tariff-driven inflation as the economy appears to be okay. I do not think the Fed should cut. Jim joins us now for more. Jim, welcome to the program. Sir, what is the most convincing argument for you right now to lead you to believe that this tariff-driven inflation is just around a corner?
There's a number of services like Truflation and Price Stats that scrape data off the internet and aggregate like a daily CPI number. They're up 1% in the last 2 months. We didn't see the data show up in the May CPI report, but I suspect we're going to see goods inflation jump in the June CPI report and in the July CPI report as well. And so I think somewhere what they're showing us is prices are going up, and it's going to have to show up in that data.
And Jim, you know the pushback, the counter-argument to all of this. The labour market is not strong enough. You won't see second-round effects. Move on. Look through this. What's the counterpoint to the counterpoint?
Well, yeah, the labor market is moderating a little bit, but I don't think we're going to see enough of it to basically offset it. And what we're going to wind up with, look, what we're talking about now is about 2.5% inflation. And I'm suggesting, especially if you look at what's called the base effect, that last year's inflation number was 0, that you're probably going to move towards 3. And if you're going to move towards 3, that's going to be enough to keep the Fed on hold. That's going to be enough to say that fair value on the 10-year note is around 4.5%. So you'll get some moderation in that stuff, but that's why you're only going to move to 3, and you're not going to move to anything more significant than that.
Jim, it seems like the market is pricing in almost fully a rate cut in September. What happens to the long end if that happens? We've been asking this question repeatedly, and it's a real question that speaks to your belief, which is we're in a higher inflation environment. Do you feel that if they cut in the near term?
That's what happened last year. When they cut September of last year, the market, the long end rejected it because it went up over 100 basis points over the next 3 months. It all really comes down to how does the market view the environment and does it think a rate cut is appropriate? Now, the problem is we're seeing more and more that it seems like it's being political as far as whether or not the Fed should cut rates. You've got the parlor game getting played. Who's going to replace Powell? They're all coming out, whether it's Kevin Hassett or Chris Waller or Michelle Bowman, who are on supposedly the short list of who President Trump is considering to replace Powell, all trying to one-up each other by saying we need to cut faster and sooner. And it sounds more like it's a political thing to kind of get into the graces of President Trump than it is to make economic arguments. If it is political, then you could see a repeat of last year. You cut rates or threaten to cut rates, and you'll produce higher long-term rates. If the market is in sync with that belief because the economics dictate it, then long rates will fall with the Fed cutting rates.
Well, it seems like right now an increasing number of Fed officials are looking to the July 9th deadline to understand exactly what the tariff rates are going to be. How relevant is that, considering the fact that you think that there is this sort of underlying inflationary environment at really any tariff level above 10%? I mean, does it matter if it's a lot lower than people previously expected?
Well, yeah, that and also non-tariff barriers and how they're going to work those out and whether or not they're going to bring down enough of those that even if the tariff rate is above 10%, that the all-in cost kind of gets moderated. But you're right. I think that, if the July meeting is in play, there's 3 events that are going to come real fast. A week from today is going to be the payroll report, July 9th with tariffs, as you mentioned, and July 15th with CPI. If any of that data is perceived as being weak or maybe, less inflationary than I think you're going to see, again, going back to the political Fed, a scream that we've got to cut rates right now, and we could put that July meeting into play in the next couple of days.
Jim, yesterday the president once again criticized Jay Powell. He said we have to get rid of this guy. He's not doing the job. Who do you think would be, after those list of names that you and I both know about out there in the press, would actually be seen as credible to the market?
Well, other than the president himself, I guess that it would be Chris Waller, current Fed governor, Kevin Warsh, who is a former Fed governor, seemed to be topping the list, as well as Kevin Hassett as well. So those are probably the big 3 names, with Scott Bessent in there, although I think he's more of a long shot, and David Malpass of the World Bank. Those are the names that are being thrown around.
But Waller and Warsh, Waller
yes.
and Warsh are currently not working for the administration. Someone like Kevin Hassett works for the administration and goes on a lot of television networks constantly and just touts whatever the president wants. Does he actually seem like a credible voice?
Well, he is a credible voice in that or he's a credible candidate, I should say, because of his background and, his training. So he would be a credible candidate. But I would also say that there's another issue, too, that if he were to pick, the president were to pick somebody like Michelle Bowman or was to pick Chris Waller, who are currently on the Fed, I think he's basically picking them to basically say, burn the thing down right now before you even become the Fed. I want the rate cuts in July. I want the rate cuts in September. If you have to hold the FOMC hostage right now to get it done, that's going to be the Hobsonian bargain that they're going to have if they're already on the Fed. If you pick somebody who's off the Fed, all they can do is go on TV and scream for it. They're not actually in the room and could actually twist arms to make it happen. So this is why I fear that we're about to, or at risk of leaving the realm of economics and entering the realm of politics when it comes to what the Fed's going to do for the second half of the year.
What do you think the consequences are of that, Jim?
If the Fed is going to be political, meaning that they're going to do something that is not in sync with the economics and is in sync with the politics of what the president wants, then I think you could see long-term interest rates, especially like in the 10-year note, shoot right through 5%. It won't like it. It'll say you're stimulating when we don't need stimulation. You're going to create more inflation. You're going to create maybe a bubble because you're going to make money cheaper when we already are at an all-time high, and it's not necessary to fan those flames even more, if that's the way the market views it. Now, if the data does slow down enough to support those rate cuts, it won't do that. But that's really what political means, is that we're going to ignore the data and we're just going to do what we want to do. And the president seems to be arguing it that way, too. His argument is we want to lower interest costs. Okay, I want to lower my interest costs, too. I want my mortgage rate to go down, but that doesn't, I don't wish it down. I need to have a better credit rating to get my mortgage rate down. We need to have the economic data justify lower interest rates, not that we wish to pay less in interest costs, which seems to be their main argument.
If they go too soon, you might see actual mortgage rates go higher. And that could be another problem. Jim, thank you, sir. Jim Bianco there of Bianco Research. This could be dramatic. It might not be. We explored this on this programme yesterday. By the time you get to September, there might not be that much daylight between what the administration wants and what the Federal Reserve is doing.
I keep thinking about what Jim Zelter said. This is the perfect fall guy for President Trump. Why would he eliminate an ultimate fall guy where there are no apparent consequences for him to keep jawboning him? Yesterday, he was saying something like, if you lower the interest rate by 2 points, by 2 percentage points, you end up with $600 billion of savings in terms of interest expenses a year. I mean, he's calculating it out and trying to figure out where to get savings. He's like, here's a place. I don't know how seriously you can take it.
He's looking at the same charts we are, and he's a debt guy, and he's saying we are paying so much more for the interest of our debt. It's surpassed our defense budget. So the president, in that sense, is looking at where he's trying to save money. He has a point. The fact of the matter is, to Jim Zelter's point, this is the perfect fall guy right now. He took another shot at him yesterday. If he's not there, then that's going to be a little bit more complicated.
We've talked a lot about how this equity market has recovered, and some, do you know what hasn't? The dollar. DXY so far this quarter is down something like 7%. I think it's the worst quarter going back to 2022.
And a lot of people are painting this now as sort of a fundamental economic picture. How many people have come on this show and said the one person making bank at every single financial institution is the FX derivatives trader? And that is the person who's going to come out ahead of everything of 2025, because suddenly, in foreign investors still investing in the U.S., but they're hedging their risk.
I think it was Jim that was talking about that yesterday.
Jim was talking about it, yeah, other people as well.
Deutsche Bank's going to join us later. They've got a similar thing to say too. Jim was talking about payrolls. Just a programming note. It's next Thursday, not next Friday. July 4th holiday here in the United States. The estimates so far, just a sneak peek of things as they come together. The estimate in our survey at the moment, 120. The previous number, 139. Let's get you an update on stories elsewhere this morning. With your Bloomberg brief, let's cross over to Yahara Arnott for more. Hey, Yahara.
Good morning, John. A trade deal between the U.S. and China was apparently signed 2 days ago. That's according to Commerce Secretary Howard Rudnick. In an interview with us, he said the deal codifies the terms laid out in earlier talks, including China's commitment to deliver rare earth minerals. China confirmed the framework of the trade deal this morning. Meanwhile, Iran is denying it's holding nuclear talks with the U.S. next week. President Trump had said a few days ago there would be negotiations, but Iran's foreign minister told state television that speculation about new discussions should not be taken seriously. He said damage from the U.S. attack on the country's nuclear facilities was considerable and serious. And a check on Nike shares. They are rising 9.3% in the pre-market after signaling its sales slump has hit a bottom. CEO Elliott Hill saying on the call there is a clear path to recovery ahead of us. Sales are still expected to dip this current quarter, but by less than expected. Nike is also taking steps to offset about $1 billion in tariff costs by raising prices and cutting back on manufacturing in China. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later this hour. Up next on the program, priming the market for a bucket load of trade deals.
We're going to announce a whole bunch of deals over the next week or so. So the China deal, we inked the deal. I think we could get a deal done now. Europe will be right at the end.
What's in store for Europe? We'll get the view from Europe in just a moment. Plus, we'll catch up with Tobin Marcus of Wolfe Research. We'll do that next. Live from New York City this morning. Good morning. At the close on Thursday, just 0.05% from all-time highs on the S&P 500. That close. Looking to breach that later on this morning. Equity futures positive by 0.2% on the Nasdaq 100, up by 0.3. A lot of hope out there under surveillance this morning, priming the market for a bucket load of trade deals.
We're going to announce a whole bunch of deals over the next week or so. So the China deal, we inked the deal. That deal was signed and sealed 2 days ago. I think we could get a deal done now. Europe will be right at the end, but you got to remember, they're our largest trading partner, so the fact that they come at the very end makes some sense.
Here's the latest this morning. The US and China confirming they've finalized the trade framework reached in Geneva. The Commerce Secretary, Howard Lutnick, adding the White House has imminent plans to reach agreements with 10 major trading partners. Joining us now from Europe, Bloomberg's Ollie Crook. Ollie, you heard it there from the Commerce Secretary. Europe will be at the very end. What are the Europeans planning to do?
Yeah, absolutely, John. And we had all the European leaders that really fresh off of that NATO meeting. Their next stop was in Brussels, where they met yesterday. And that's where they're sort of beginning to have this conversation. I say continuing to have this conversation. And the conversation around the table for European leaders is basically how much pain are you willing to take from the United States? How imbalanced a trade deal are you willing to accept from the United States? And what we're hearing from a number of different leaders is a little bit more pragmatism. Originally, we heard from Emmanuel Macron. He was still aiming for that 0-for-0 deal. We heard from his commissioner here in Europe saying that basically even that 10% barrier would prompt retaliation from the EU. We're getting some pushback on that narrative. We heard from the German Chancellor Friedrich Merz. This was his first leaders meeting yesterday. I'll quote directly what he said. He said, "It's better to go fast and simple than slow and highly complicated. We need to reach a deal very quickly, and we've all agreed to that. There is no disagreement there at all." We've heard similar things from the likes of Giorgia Meloni. So right now for European leaders, though they feel that what the U.S. demands have been, and we don't know what those demands are in great detail, are asymmetrical, are unbalanced, are unfair, they're willing to compromise, it seems, to get a deal done pretty fast. That being said, I think it's very unlikely that we get that full deal by the July 9th deadline. Hopefully, I think what they're trying to get right now is to get sort of a broader framework in place so they have a little bit more time to negotiate. I wouldn't be surprised if Ursula von der Leyen has to get on a plane in the next couple of days to go to Washington, D.C.
Ollie Crook, they might be very busy for the next few weeks. Appreciate the update. Oliver Crook there out of Brussels this morning. I think from the White House side of things, there is just this belief that to rebalance the trade with any nation, with any trading bloc, the agreement needs to be imbalanced in order to rebalance. And how much of an imbalance you're willing to accept on the other side of the deal seems to be a bit of a sticking point.
Interesting, though, what Oliver's saying. This sounds actually even very different than what I heard earlier in the week when I was in the Netherlands, that they were going to have this tremendous amount of pushback in the European Union. Maybe they realize actually that tactic is not going to work, especially if we want an agreement by July 9th.
That's Europe. Let's talk about China. Tobin Marcus of Wolfe Research joins us now for more. Tobin, welcome to the programme. I just want to pick up on the language, the words used by the Commerce Secretary, Howard Lutnick. We inked the deal. What's the deal? Do you have any details whatsoever?
This seems to be the third time that they've inked this particular deal, because it seems to be a solidification of the framework to get back to the Geneva consensus that was reached about 2 months ago. So it's good to have that locked down, but it does not really look to me like that's delivering any kind of incremental relief or incremental steps forward. It's just solidifying the sort of set of understandings that was required to keep the trading relationship from going further off track in terms of access to rare earths on their side and the rollback of some of the incremental export controls on our side.
I was at those talks in London, and I still can't get from this administration an idea of what the language looks like, who signed it. The Chinese say earlier this morning the U.S. side will correspondingly cancel a series of restrictive measures taken against China. Which measures?
So it seems, from my perspective, that the Chinese have been primarily focused on the further expansion of export controls that took place after the Geneva meeting. So certainly the restrictions on natural gas liquids, on aerospace, on EDA software, those I think are clearly in the set of things that are going to be rolled off. The initial vote of contention from the Chinese side was this declaration that anyone using Huawei send chips is in violation of U.S. export controls, that the U.S. side characterized as a restatement of existing policy and the Chinese side characterized as incremental expansion of export controls. So that, in my mind, is the question. I don't think that the U.S. Has committed to rolling that back, but that, I think, is sort of the final piece of wiggle room in how we understand this.
This isn't a trade deal. This is just an understanding of some of the de-escalation we've seen in these talks in Geneva and London. So where does this leave the relationship more long-term for more of a comprehensive agreement?
It still looks very challenging to me. I think that the bullish narrative in markets immediately after the Geneva meeting was, we've come down to 30, but of that 30, 20% is fentanyl related. And that should be an easy thing for the Chinese side to alleviate Trump's concern on. This is an authoritarian society. Well, we should just think that they can flip a switch and do whatever they need to do on export controls on fentanyl precursors to satisfy the U.S. side. I think that's easier said than done, even to the extent that they can fully allay our substantive concerns. There have been multiple rounds of headlines from Bloomberg, among others, about Vietnam aiming towards a 20 to 25% tariff rate in their talks. Even if we reach a deal, that's what the deal will consist of. And if we're taking Vietnam to 25, it does not really make sense to take off that 20% fentanyl tariff and leave China at 10. It would be very upside down to go after Vietnam, where the main concerns have been around them as sort of an outlet for Chinese industrial overcapacity and transshipping and so forth, and hit them harder than China itself. So I think we have a long way to go. The Chinese love slow deliberative mechanisms, and that's what we have in place now. And I think these talks will drag out for quite a while longer before we get further incremental easing.
Isn't that, Tobin, kind of what we expect across the board, that this is going to be a process and there are going to be frameworks that are going to be announced on July 9th that will then kick the can down the road? And right now the market is banking on escalate to de-escalate, as John was talking about when it came to Iran, but also when it comes to trade deals and what the path forward is likely to be for the president.
Yeah, so I think I am less optimistic about exactly what these deals are going to deliver in terms of market relevant relief than I think sort of hullabaloo about deals in general and deal making as an enterprise would suggest. Lutnick's indication that there's going to be 10 of these deals announced, we'll see. They've been teasing a bunch of deals right around the corner for about 2 months now. But even if deals get rolled out, again, Vietnam being, in my mind, sort of the easiest or most important example, we seem to be aiming towards a significant increase in reciprocal tariff rates in that set of talks. So if we roll out that deal, that's not like good news for the market. It's not good news for Nike, to take one name that was mentioned just a moment ago. And similarly elsewhere, like the sectoral tariffs have been the sticking point primarily with Japan, with India to some extent. They will be a huge sticking point with the EU, although those talks are not quite as far along. It doesn't really look to me like the U.S. side is going to give on those. And so if we get a bunch of deals that don't drop the sectoral tariffs, I don't really think that this represents a big kind of dovish impulse for markets.
Tobin, appreciate your time and your opinion. Thank you, sir. Tobin Marcus there of Wolfe Research. We can debate whether things are good. Ultimately, they're better across 3 different dimensions. On trade, they're better now. Things are better now than they were on April 2nd, that's for sure. On taxes, they're better now than they were about a month ago. And on geopolitics, they're certainly better now than it was just last week.
Yeah, tail risks on, tail risks off. That really has been sort of what we have seen. I will say, if you take a look at the data, the economic read-through, Toyota, for example, raising prices of cars in the U.S., China's industrial firms taking a hit on margins from some of the tariffs, it's being borne out in a lot of different places.
That's the ongoing argument.
Yeah.
Who's going to take the tariff hit? And we'll explore that argument through the next hour or so, and the next several months, and the next several years, and maybe beyond. Coming up on this programme, Tim Baker of Deutsche Bank with the US dollar at 3-year lows. Plus, Danny Berger with your morning movers, with Nike jumping in the pre-market by 9%. Coming into Friday, 0.05%. away from all-time highs on the S&P 500. Equity futures here positive by another 0.2%. Striking distance of all-time highs on the S&P. On the Nasdaq 100 up by 0.3. In the bond market, 2-year bond yields in focus at the front end of the yield curve. Coming into Friday, for 5 consecutive sessions, yields lower through Thursday. Down about 16 basis points on the week now. Retracing some of that move, we're up by 2 or 3 basis points. More on Fed interest rates later on in the program. I want to finish on foreign exchange, switch at the board and get to the euro. The euro having a look at a 7th consecutive day of euro strength against dollar weakness. Euro dollar is through 117. We'll get back to the FX market in just a moment. Let's take the opportunity to get you some morning movers. Let's do that with Danny Berger, who has more. Good morning, Danny.
Good morning, John. Leading tech higher this morning, leading the Mag 7 higher, or at least overall stocks higher this morning, I should say. I'll get to tech in a moment. Nike outperforming. It is up 9.1%. The hope is that because they forecast the current quarter to be better than expected, that the bottom is in for this company, that things are starting to turn around. It's been a series of steps the CEO has put into place, trying to help with stock, trying to focus on athletics, though they did not give an outlook for the full year given tariffs. You're also seeing other athletic companies rebound off of this too. Adidas in Europe, here in the U.S., Lululemon also doing better off the back of the outperformance in Nike. Those shares up more than 1% this morning, maybe giving hope it's not just a Nike story, but consumers are buying and you can become cool again. Finally, we'll wrap it up with Amazon getting an upgrade from Exane this morning. That's the one that's leading Mag 7 higher. It is up almost 1%. Exane saying that among the hyperscalers, that Nike is the most poised to outperform, that eventually through 2030, they're going to start to be hit by depreciation costs. But Amazon looks more attractive when it comes to controlling their margins, John.
Danny, thank you. More from Danny in the next hour. Tech leadership has been absolutely stunning. JP Morgan and the team in the investment bank out with their mid-year outlook. The growth slowdown and higher for longer rates are likely to lead to a repeat of the 23-24 playbook of narrow leadership and high market concentration. It's been a theme.
Yeah, and one thing that people have pointed to is that valuations look elevated, except that they don't suddenly, because profits have been so big at these tech companies that their valuations are actually coming down even as their stock prices go up. So it just shows the conundrum of trying to bet against the behemoths of the United States.
Nasdaq futures up another 0.3%. On a radar this morning, the US and China signing a trade truce after finalizing an understanding last month in Geneva. The White House saying it has imminent plans to reach agreements with 10 other trading partners. Big question, who's the 10?
Who's the 10? Potentially India. The president mentioned them yesterday, and they've been out front in terms of this negotiation. Remember, Prime Minister Modi, first leader basically to come here after the inauguration for a meeting. Maybe Japan, the European Union. We know that would be a little bit more complicated. I'm still stuck on what's going on with China. What did they sign and who signed it? They signed basically an agreement based off the Geneva and London discussions. But what's in the details? We know rare earths is potentially, but how much did the U.S. go in terms of rolling back some of those export controls? And is that going to implicate national security concerns?
Yeah, just to build on that. I mean, John, what you say is the big question is who are those 10 partners? The big question is also what did the U.S. give up? Also, the question is what are the countermeasures? Also, the question is
big question.
I mean, there are a lot of kind of vague aspects of this. And I think that that's the real question. Why is the market feeling like this is a real positive development? Because right now there is a feeling of a wish to de-escalate. And so even if this is kicking the can down the road, this means that probably there isn't going to be a re-escalation that could reintroduce a tail risk to markets.
And to your point, Lisa, not just on trade, not just on geopolitics, also on taxes. Republicans dropping the so-called revenge tax from the big, beautiful bill after the Treasury Secretary Scott Bessent announced a deal with G7 allies that will exclude U.S. companies from some taxes imposed by other countries.
So Wall Street is definitely going to be breathing a sigh of relief from this, especially global Wall Street. There was this fear that it would make forcing individuals, basically, and companies to not want to invest in the United States. It just goes to show that potentially this whole revenge tax was basically just used for them to go into and negotiate as leverage, and they weren't ever really going to put it in the one big beautiful bill.
Lisa said it. We were talking about escalating to de-escalate. We're de-escalating going into July. That's why we are very close to all-time highs.
It feels like the adult in the room says, cut it out, guys. This is idiotic. And that's kind of what it sounds like is happening.
Who's the adult? Scotty B?
That's Scotty B.
That's what a lot of people think, right?
Yes. And he's the one that announced it yesterday. Actually, his deputy also hinted at the negotiations on balance of power 2 evenings ago. So we got a hint that potentially this was in the works. And the Senate came out, Senator Crapo came out and said, yeah, we're getting it out of the one big beautiful bill. But remember, the House voted on it. So now the House has to deal with all of these edits and either swallow them or put up a fight. And I think you're going to see a fight.
The Treasury Secretary, we should say, and not Scotty B. That's the president's
What's
name.
what the president calls him?
So we can't call
the
him
president can call him whatever he wants, but I think we should stick with Treasury
You think
Secretary
so?
Scott Bessent.
Maybe he'll have like a hat.
Or you could say
Scotty
Treasury
B.
Secretary Scotty B.
Scotty B. We'll ask Scott himself. Let's turn to this story. Andrew Cuomo is staying in the New York City mayor's race. Sources telling us here at Bloomberg his name will appear on the ballot in November as an independent after a stunning defeat in the Democratic primary to the Democratic socialist Zohran Mamdani.
This is the race to avoid a spoiler. How do you coalesce all of the anti-Mamdani votes around one candidate? And yes, all of a sudden people are saying, corruption charges, is that so bad? Sexual harassment charges, is that so bad? Which one are we going to really fall behind? Because ultimately, if you do have a tax on the wealthiest individuals and you do have some of the policies that Mamdani put out there, people are talking about an exodus from from New York City. So this really is going to be a battle. How do you coalesce all of the other votes around a candidate who's not running on the ticket that normally wins the mayoral race in New York City?
Also, there's this concern that Cuomo is not going to run a very active campaign. And then you have the likes of Eric Adams in the race now. And if your whole goal is to basically say, we do not want Zohran Mamdani to win this race, then you have to get rid of one of those alternatives and go behind one person. But Cuomo says he's staying on the ticket. So to your point, it might be a spoiler.
It's a battle and the victim is the city. And that's the problem. And I think it's important to frame who the battle is between the Democratic establishment and the extreme fringes of the Democratic Party. It's their argument. It's their argument also on the national stage. It just happens to be playing out here in New York City, and that's unfortunate for this city.
You know, John Lieber put it well. This is not a welcome development for the Democratic establishment, because right now there is a real battle, and it is not between Democrats and Republicans. It's between the different fringes in both parties versus a more centrist traditional party that is trying to figure out how to move forward. And this is a battle that's going to play out over a lot of years.
This is the center of not just the United States, but the world in terms of capitalism and business. He was asked last night, Zohran Mamdani, on CNN, do you like capitalism? Quote, no, I have many critiques of capitalism. There must be a better distribution of wealth in this country. That is not going to fly with the majority of people living in this city.
A lot of coverage on this story still to come. Let's turn back to the markets. The dollar falling to a 3-year low on renewed bets of a Fed rate cut this year. Tim Baker of Deutsche Bank writing the calming of geopolitical risk removes a driver of dollar strength. Tim joins us now for more. Tim, welcome to the programme. You've written lots recently about selling versus hedging dollar exposure. Could you walk us through that? Just help us understand what's happening here, because it sounds like from your perspective, people aren't selling dollar exposure, they're hedging it. What's the difference, Tim?
Yeah, the difference is over the last few years, you've had global pension fund managers, life insurance companies, sovereign wealth funds invest heavily in US assets. That was the place to be. That's where you got a stack of safe assets in the form of treasuries. Perhaps more importantly, you've had the best performing equity market in the world. So it made sense to accumulate dollar exposure these last few years. Hedging it to remove that currency risk, that it wasn't done quite as much. It's been very expensive to hedge the dollar over the last few years. And hey, what's the point in hedging against it? It's doing well. So we come into this year and we do a deep dive on the numbers. December quarter, March quarter, globally, these pension funds, lifers have been very light on their hedge ratios because of that. There's just a lot of unhedged US dollar exposure. And that runs headlong into the German fiscal shock, a shift in correlations between the dollar and equities, the dollar and yields, and then we get Liberation Day and all this US policy uncertainty. So these foreign asset managers are kind of thinking, hey, hang on, I thought I'd be okay with exposure to the dollar. It's hurting me a little bit. Maybe we need to revisit that. Now, they can do that relatively quickly. I don't think they've done it entirely yet. I think there's still more to go. I mean, probably Asia, Taiwan specifically, has done quite a bit already, but I think that's still a story in train. As far as actually moving away from US assets, that's a bigger decision. These kind of staid and steady pension fund life insurance companies, they have quarterly investment committee meetings. Let's think it all through. I think that lies ahead. What's most interesting there is that Canada sold a ton of US assets in April. No one else did really, but Canada did. Why is that interesting? Because Canada was one of the first affected countries by Trump's tariff threats. This is like February, March, there were threats. So, after a couple of months, maybe Canada took the view, we want to pull back some of our very heavily overweight US exposure. If that's kind of the canary in the coal mine, we might expect more selling of dollar assets as the year progresses, as a delayed response to US policy uncertainty. So I think both of these are very important, the hedging and the allocation story, because it kind of marks a big turn in the dollar. And yes, the dollar's fallen a lot already, but if we're talking about a big, once in a decade kind of shift away from US dollar exposure, whether it's lifting hedge ratios or selling US assets, there's plenty more in this dollar down cycle to go.
There's so much to unpack there, Tim. This whole tail risk on, tail risk off. There's been a belief that where this is the end of U.S. exceptionalism, and it's really evidenced by the decline, the weakening in the dollar. The idea of it just being simply hedging risk after more than a decade of being benefited by both the strengthening in the dollar and the rise in U.S. equities is a lot more of a sanguine picture. If it were just that, if it was just increasing the hedges, how much more weakening would there be to go?
Yeah, it's the coalescing of a lot of things, right? It's not only that, but, the dollar is historically expensive. The current account deficit has been widening. The fiscal deficit is large and, look, it's not shrinking, right? Probably widening. So all these things come together. So I guess I just make the point that, earlier in the year, you could say, hey, German positive fiscal shock, US negative shocks around tariffs, and the euro dollar move you might have expected on the back of that. Maybe that's all been and gone, but these bigger vulnerabilities and this positioning overhang and this large unhedged position, all of this stuff's coalescing. I think that initial kind of response, just from kind of fast money, how we respond to the news flow through February, March and April, that's probably done. And when I look across positioning indicators, dollar shorts aren't what they were, but I think it's kind of carrying you're handing the baton over to pension funds, to lifers on the hedging, and the reallocation story lies ahead. So I guess it's kind of multi-stage. How far does it go? When the dollar's really rolled over after past peaks, you're looking at 20% at least down in a year, more like 25% plus. We're not quite that bearish. We've got euro dollar for 120 end of the year, for example, dollar yen for 135. It gets some support from still being a high yielder. Now, that's taking a little bit of a knock this week with some of these dovish Fed speakers, but another 10, 15% down over the next year is certainly possible. This is a big shift and the dollar tends to trend. And so there's volatility, the week-to-week news, I guess, around that structural downtrend we still see in place.
Hey, Tim, smart stuff as always. Thanks for the update. Tim Baker there of Deutsche Bank, looking for 120 on euro dollar. We might get there in a few weeks. 117 right now.
Yeah, I was also curious about what he said about Canada. I wonder how specific the anger from Canada actually is about selling the assets versus other places, because you did see huge Canadian outflows from the U.S. You've also seen tourism fall off a cliff. They're just bypassing the U.S., but tourism from other places has changed. So it's a particular wound and resentment for being sort of deceived.
They're pretty bitter about things, that's for sure.
And they're so kind. But, I understand.
It's kind bitterness or bitter kindness.
Well, it's the kindness that's been thwarted that is resentment that is very difficult to
shouldn't laugh about it. It's a serious issue, I know that. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg brief with Yahara. Hey, Yahara.
Hi, John. President Trump says that a trade deal could be signed soon with India that would open up the Indian market to American business. Negotiators are set to meet in Washington to break a recent deadlock over key issues. Trump's reciprocal tariffs are set to take effect on July 9th, and an early deal would help India avert the hike. Meanwhile, the Bank of England is considering softening new trading book capital rules to push ahead with global banking reforms by 2027. This aims to keep UK banks competitive with Wall Street, especially since the UK's approach won't raise capital demands, which are in the EU and US's plans. An update from the central bank is anticipated this summer. And Xiaomi shares touched a record high after initial orders for its new $35,000 SUV came in very strong. The company says that within an hour of launching, it got over 289,000 pre-orders for its U7. The new model will be a key test of demand for Xiaomi cars after a fatal crash involving a different model sparked scrutiny from Chinese authorities. That's your Bloomberg brief. John?
Yahara, thank you. More from Yahara in about 30 minutes from now. Up next on the program, a full rate cut.
One of the challenges of central banking that you just have to accept is that we never have perfect data. We can't wait for perfect information or we'll be behind, and we can't do that to the American people. The fall looks promising for a rate cut.
Neil Dutta of Renmark thinks it might come sooner than that. He joins us next on the program. Live from New York, you're watching Bloomberg TV. Up on the week so far on the S&P 500 through yesterday, higher by close to 3% on the S&P. It would be the biggest weekly gain going back to mid-May. Equity futures added some weight to the rally, up another 0.25% on the S&P 500. On the Nasdaq 100, up by 0.3%. Under surveillance this morning, a full rate cut.
You have to make a view. You have to have a view about what you think tariffs will do to inflation. Now, my own view is that they will potentially raise inflation, but they should dissipate. One of the challenges of central banking that you just have to accept is that we never have perfect data. We can't wait for perfect information or we'll be behind, and we can't do that to the American people. The fall looks promising for a rate cut.
Here's the latest this morning. Investors boosting Fed rate cut bets for this year as President Donald Trump talks about naming a replacement for Fed Chair Jay Powell. Neil Dutta of Renmax saying, quote, what Trump needs are people that can intellectually defend arguments for dovish monetary policy. Chris Waller is that person. Joining us now is Neil Dutta of Renmax. Neil, welcome to the program, sir. If Waller is the right guy, who's the wrong person and why?
Well, I mean, I think it's pretty clear who I think the wrong person is. I've said it. I thought he was the wrong pick for Treasury Secretary, and I think he's the wrong pick for the Fed. Yet President Trump continues to play footsie with him perpetually throughout his political career, and that's Kevin Warsh. But you know, I mean, I've been on record as saying Waller is the guy. I think he's an out-of-the-box thinker. You know, he's already there at the Fed. So you want to talk about a shadow Fed chair. I mean, he was on the financial media not too long ago advocating for a July rate cut. So, you know, he's already making the arguments within the FOMC as it is. And he's going out and kind of litigating them in the public. So, you know, that shadow Fed chair idea, we already have one. And his name is Chris Waller.
How economically defensible, Neil, do you think his argument is?
Well, I think his argument makes a lot of sense. I mean, if you look at, I mean, basically it's a labor market driven view, right? You know, they've said for the longest time that the labor markets are no longer a source of inflationary pressure. What if we're transitioning now to a point where the labor markets are becoming a source of disinflationary pressure? And the reason that could be is because the stock of unemployed people continues to grow. We see that now it feels like week after week after week with extended unemployment claims rising. And that's primarily been so far because the hiring rate has come down. But typically in an economic cycle, hiring tends to turn first before layoffs turn up. And so that to me is the concern. And if that happens, you'll get a much more rapid increase in extended unemployment claims and unemployment more generally from here.
Neil, you've been harping on the idea that there really should be rate cuts and that this should be a much more dovish Fed and that there really is no reason for them not to cut. Right now, we have 2 to 3 rate cuts getting priced into the market with September being almost a lock. Is that enough for you? I mean, isn't that basically the same thing that you're saying? Where's the daylight here?
Well, I mean, you know, these things tend to move in waves. I mean, it's sort of slowly, then all at first. I mean, I do think the markets, I think, are still looking for a smoking gun. And, you know, to me, that could be a negative payroll print at some point over the next few months. And when that happens, I think the markets will begin to price in more rate cuts between now and the end of 2026.
I guess that's really the question, Neil. It seems like over the past couple of weeks, people have moved away from this rubric of a smoking gun or some sort of break in the labor market to we're seeing disinflation. We may see ongoing disinflation today with core PCE when we get that out in a little less than 2 hours' time. And the Fed, if it's coming without any kind of sense of, real acceleration in the labor market, will give them the right to cut. I mean, isn't it sort of the Fed's moving in the direction that you want it to go in? I mean, do you really disagree or take issue with what they're doing right now, given that the rhetoric is coalescing around September and possibly another rate cut this year?
Well, I mean, I guess the question is, are we in a situation where the labor markets are slowing in such a way that it's getting away from them that creates, a more of a need to step out in front? I mean, that to me is what I'm worried about. It's encouraging that they're moving in the right direction, but going 2 or 3 times this year and a couple of times next year, which is sort of, I think, where the market's at, I don't really think that's going to get the job done for the U.S. housing market. And so, if the housing market's not really providing a tailwind for growth, And it's possible that you start to see some slowing from the AI CapEx euphoria that we've seen this year. I mean, remember, that's turned into a macro issue, right? I mean, you've had a massive CapEx boom because of AI and tech. If that starts to recede, you're talking about additional downside risk to 2026 that people haven't really talked about yet.
Neil, if we could just get back to the Fed race. You were very supportive of the Treasury Secretary, Scott Bessent, to be the Treasury Secretary. Why not Fed Chair Bessent?
Well, Annmarie, who was the first Treasury Secretary of the United States?
Charles Hamlin. Treasury Secretary was Alexander Hamilton. The Fed Chair was Charles Hamlin.
Well, you must have looked on Wikipedia, because most people, I mean, they're writing.
Because I knew this is your thing.
They're doing musicals about the Treasury Secretary, Annmarie. Call me when they do one about the Fed Chair. And
so you think he wants a musical after him?
That's why Bessent wouldn't want it, I don't think. I mean, to me, it's being in the Treasury Secretary means you're in the room.
So the other thing is Breitbart's John Carney has actually promoted your name to open up potentially if a board seat opens up. Is that something you're seriously considering?
I mean, I haven't. No, I mean, I'm very happy with the job that I have. It's nice to be considered, but these are jobs that require you not only to have advocates on the outside, but also advocates on the inside. But I do agree with the idea that the Fed needs out-of-the-box thinking to support the new chair. This is, sometimes it's way too much of a consensus building type of institution. I think it's healthy sometimes to have like an open and vigorous debate and just let the chips fall where they may.
Neil, we don't do endorsements here, but if we did, Neil Dutta of Renmark. Neil, thank you, sir. Appreciate it,
it's out
as
there
always.
In the ether.
You knew that was coming, didn't you?
Yeah, he told me. This was his argument all week when I was asking him about it. So then I looked up who were the first few. And Charles Hamlin actually was a lawyer. Very Powell-esque.
Very Powell-esque. The Treasury Secretary, Scott Bessent, as you know, knowing the guy personally, he's very proud of having this position. He refers to himself often in all these conversations he has with the media as an economic historian or a student of economic history. That's where he wants to be. Now, I know a lot of people here on Wall Street would like to see him also as the Fed chair, but I think that's the view from people inside the conversation with Bessent at the moment.
I didn't get a sense that he wants to move to the other side of Washington, D.C. anytime soon. He's very happy with the position he has, and he also said that in testimony in Congress. But of course, there are people who think he's doing a really good job and prefer to see him at the Fed.
Can we imagine Dutta on the FOMC? I think we can.
I think that would be, he'd be a rabble-rouser. He definitely would. I'm just still trying to imagine the musical with Scott Bessent and what the songs would be. I'm trying to have it,
You do you. Go at it. We've got a commercial break coming up.
Good, so I could just sit here and do that.
Have a think about it. It's Friday.
Yeah, well, one thing that I didn't ask Neil Dutta that I'm actually curious about, if they cut substantially, would that help the housing market? How much would that actually contribute that? And that, I think, is one of the key questions. If you don't have, to your point that you were asking yesterday, John, if you don't have a credible Fed chair, do you get the results that you ultimately want if you do cut?
I would say, look, the market gets a vote on this before the Senate does, and ultimately you select the wrong person. It makes it harder to cut, not easier. Up next on the program, Seema Shah of Principal Asset Management, Monica Guerra of Morgan Stanley, David Mericle of Goldman Sachs, plus Marissa Adams of HSBC. The second hour of Bloomberg Surveillance, up next.
The economy is amazingly resilient in the U.S.
Don't confuse Wall Street, i.e. the S&P 500, with Main Street, i.e. the broader U.S. economy.
It is very clear in the data that the U.S. economy is slowing.
Consumers are still very worried about the future.
If you start to see labor market weakening, then for sure you will see the Fed act.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning. The second hour of Bloomberg Surveillance starts right now with equities that far away from all-time highs on the S&P 500 after the close yesterday. Your scores look like this. Equity futures positive by 0.25%. We had some weight to the rally on the Nasdaq 100, up by 1/3%. Things are better across three dimensions on trade, taxes and geopolitics, and that's why we're within striking distance of a record high. Later on this morning, 8:30 Eastern Time, more economic data. Core PCE just around the corner, following a pretty big rally at the front end of the yield curve so far this week.
There's been a belief that you can get disinflation without the weakening in the economy that so many people have been worried about. Yes, we are seeing a weakening. It is not being perceived as weak. It is not being perceived as this labor market actually breaking. And if you see spending continue relatively strong with inflation coming in, how much fuel does that give to this feeling that the tail risks keep getting removed?
And the White House with a much more relaxed posture leaving Q2 than how they came into Q2. April 2nd, a lifetime ago, going into July, things feel a whole lot better.
So no one thinks we're going to go back to those tariff rates we saw on April 2nd, Liberation Day, because there will be, at least in principle, deals with a number of trading partners. But will they come by July 9th? I think that is still some of the risk we're seeing, because I'm not sure you can get all these partners done in a week and a half. But I think people need to be cautious. Yes, a bill will get done. Yes, trade deals will get done. But it's not so neat right now. We haven't had a single trade deal being announced since the United Kingdom. This idea of a framework with China only hosts a few issues. And then when it comes to the one big beautiful bill, July 4th is 1 week from today. The text is still with the parliamentarian in the Senate, and they are striking down a number of issues. There is a lot of hurdles and churn that Washington needs to go through.
Elisa was talking about the data. Weakening maybe, but not weak. Look, on these situations, trade and taxes, things might not be great, might not even be good, but they're better. They're better than where we were just a few months ago.
And it raises a question, is that enough? Is that enough to keep reaching new highs, just that it's not as bad as it could have been? If you take the tail risks off, do you have something that can keep accelerating going forward? And ultimately, that might be the biggest question, because you do see the potential for margin compression as companies increasingly absorb some of these costs. And there are real questions about how much more consumers are willing to absorb when you hear a number of retailers talk about having to downgrade or even withdraw some of their earnings estimates. So the jury's still out, not necessarily whether there's going to be Armageddon, but whether there's going to be a greater degree of profit margin weakening that is going to erode some of the euphoria.
And when you talk about tail risks being taken off, even just last night, the Treasury Secretary announcing that they're getting rid of Section 899 because they did a deal with G7 leaders. That was something that people were very concerned with abroad. Would individuals, investors, big firms want to continue to invest in the United States? That's one risk already being taken off. So to your point, maybe it's not great, but it certainly is better.
The mood music improves. On regulation, on taxes, on trade, on geopolitics. Then you go into the third quarter and you start to focus on the labour market data just a little bit more. You've been bringing this up all week, Lisa. I'm right there with you. If you're reducing interest rates because you're seeing these disinflationary trends, you're not getting that tariff bump that everyone was worried about 2 months ago, that's one thing. If we start talking about interest rate cuts because this labour market is starting to crack more than that, then you've got a problem.
And that's, I think, what people are not counting on. And that, I think, is really the ultimate question for the remainder of this year. Can you have the stasis that we've seen in the labor market without an eventual further weakening that does show up in terms of sentiment, in terms of spending? I keep looking at recent college graduates and the fact that their unemployment rate is about 10% or higher and has been climbing. And when you take a look at that, you just wonder what is really the message in terms of how dynamic this market is. Neil Richardson was talking about that yesterday.
It sets us up for next week. Payroll's just around the corner. Next Thursday, remember, Friday's a holiday stateside. The estimate in our survey so far, 120. The estimate is 120 as we put those estimates together. The previous number last month, 139. Coming up this hour, we'll catch up with Seema, Shah of Principal Asset Management, with stocks pushing towards all-time highs. Monica Guerra of Morgan Stanley as the US and China confirm a trade deal is on the table, and Marissa Adams of HSBC on the prospects for an agreement with Europe. We begin this hour with stocks inching towards a record. Seema, Shah of Principal Asset Management writing the valuations are fairly unattractive, but investors may gradually re-risk if news flow over the coming few weeks is constructive. Seema joins us now for more. Seema, welcome back to the show. The pain trade, so many people have talked about it. Is the pain trade still equities higher and leadership a whole lot narrower?
Hi, John. Yeah, I think it is. I mean, I think when we're certainly when we're looking at the economic backdrop, and you're right, things have improved from April, but when you're comparing it to January, you've seen economic growth downgrades, you've seen inflation forecasts being pushed up, you've got tariffs ultimately ending up at a higher level than when they started the year. So does it really make sense for equities to be hitting new record highs? I think that is a pain trade. For the next 3 months, I think if you're looking out over a 12-month period, actually, I think that things can be a little bit more constructive. So if you're taking a long-term view, then certainly being risk-on. But in the near term, I do think there's a couple of potholes, bit of volatility to come.
Seema, take that 12-month rolling view of things, of the world. Why do you think things improve 12 months out?
Well, I think generally, look, we have got some concerns about the labour market cracking, but we're not seeing many signs from either large businesses or even small businesses that they're planning to introduce major job cuts. we do think the Federal Reserve will eventually start to cut rates. The general picture is one of a fairly, modest growth world, but you just need modest growth in order to have earnings growth, and therefore to push up risk markets. So I think overall, it's a fairly constructive outlook. It's just not as constructive as maybe you had in 2024 or 23.
Seema, the one constant has been, and it has been a change since February 19th, is that we've seen dollar weakening. And that has been a consistent story, even with this V-shaped recovery that we've seen in both the S&P and the NASDAQ. At what point does that hold in terms of an asset allocation point of view? In other words, the rest of the world still looks better than the U.S., even though the U.S. has shown a great degree of resilience and a lot of tail risks have been taken off the table.
Well, actually, I think that a lot of that is starting to lose a bit of momentum. In Europe, for example, of course, it's done wonderfully, a lot of optimism in discussions. But now you're getting to the point where investors are saying, well, look, show us the money. When is Europe really going to implement? When are you going to see infrastructure? When are they realistically going to talk about deregulation? And then once they start to see that, which of course could come at any time, but realistically, as Europe, things start to take a bit of time. If you do start to see that, then I think there's more of a secular growth potential coming through in Europe. So I think for the time being, we're almost reverting back to the US. In terms of certainly allocations, we're still very much overweight risk US assets.
So, Seema, if you're allocating back to the U.S., is it on a hedged basis, or is this unhedged back to the old playbook? Because it looks like maybe some of the statements of the U.S. exceptionalism's death were vastly overstated.
Yeah, to your point, I think a lot of those concerns were overstated. I don't think that narrative is necessarily going away, and we are, for example, expecting further dollar weakness over the coming months, quarters, because some of the shine has certainly been taken off the US. There's a real spotlight on the deficit, and of course there is greater potential. Still potential. It's not real at the moment, but it's still greater potential in other parts of the world. So I think there's a continued decline in the dollar, but I think that the US exceptionalism story for now is still intact. It's just that there's growing questions. And for other countries around the world, this is probably their moment. This is the moment that they can take the bull by its horns and maybe improve their growth prospects over the long term.
Seema, in your latest note, you talk about still tariff concerns and shipping costs that could derail the normalization process when it comes to inflation. When you look at all the uncertainties that are in Washington, D.C., is that the one that you want them to get a handle on as soon as possible?
Yeah, I think so. I think for companies, look, all companies will eventually adjust to trade uncertainties. They'll find their ways through the supply chains. But you are seeing that companies are holding back on investment plans still. They're holding back on hiring because they just don't know what's coming. Now, in the next couple of weeks, will we find that clarity, that certainty with regards to tariffs? I very much doubt it. I think that over the next 18 months or so, you're going to see this back and forth, potential resumption of hostilities occasionally. So I think that we almost have to get used to this lack of certainty, which unfortunately is going to weigh on businesses. I just don't think it's going to be the point that they start to capitulate entirely because of this uncertainty.
But you're confident that we're not going back to the maximalist approach we saw in early April?
Yeah, I think so. I think the administration has learned a fair amount from that experience. 145% tariff, that's the almost the kind of the stoppage of trade between the US and China with major implications on US growth. So I think from that perspective, that's not something they want to go back to. But we are going to have higher tariffs than what we started the year. We're expecting an average effective tariff rate of around 14 to 15% by year end, and that's up from 2% at the beginning of the year.
Seema, just before you go, you're in London, I believe. Just to reflect on the last few months and the changes in behaviour and attitudes towards US assets. Price, of course, shapes narrative. It also conditions behaviour. And I just wonder, from your standpoint, the conversations you have every day in Europe, have you seen a permanent attitude shift towards US assets? Or with this rebound, is it bringing the attention back to America and, dare I say, American exceptionalism all over again?
It's an interesting question. So I think cyclically, people are starting to look back to the US because they've seen that the market rebound. There's hope still about technology, etc. But I think that there is a structural decline in the US because there are genuine questions about the reliability of the institutions, not just within the government, but in terms of universities. And that is weighing on people's perspectives. So I think cyclically we're okay in the US, but structurally there is a conversation going on about looking outside of the US more domestically. And I don't think that conversation is going to go away anytime soon.
Seema Shah of Principal Asset Management. Seema, Thank you, as always. Of course, this is playing out in the FX market. That dollar story, dollar a whole lot weaker over the past few months.
Yeah, and I wonder how much that actually has the opposite effect of bringing people from the EU to the U.S. I mean, think about it. Everyone who went to Southern Europe to have a vacation because of how strong the dollar was, well, come over to our house. There's sort of that kind of feel, and you do see that in some of the foot traffic, at least anecdotally.
117 will do that.
I think so.
You're hearing the accents and the languages in Midtown Manhattan.
I mean, the air train out of control. I mean, you're just definitely seeing this sort of percolation of new tourism flows that come on the heels of a weaker dollar.
Terrible quarter so far for the US dollar, down I think about 7% so far on the quarter. Still a couple of sessions to go to round out Q2. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara with more. Hey, Yahara.
Hi, John. Iran is denying it's holding nuclear talks with the U.S. next week. President Trump had said days ago there would be negotiations, but Iran's foreign minister told state television that speculation about new discussions should not be taken seriously. He added that damage from the U.S. attack on its nuclear facilities was considerable and serious. Meanwhile, the U.S. Treasury Department has reached a deal with G7 allies to exempt American companies from certain foreign taxes. That's in exchange for removing the so-called revenge tax proposal from President Trump's tax bill, which had raised concerns on Wall Street about discouraging foreign investment in the U.S. And Indian authorities say they have extracted data from the 2 flight recorders retrieved from the Air India jet that crashed 2 weeks ago. All but one of the 242 people on board the Boeing 787 were killed when it crashed just seconds after takeoff. The cause of the accident remains unknown. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate the update. More from Yahara in about 30 minutes from now. Up next on the program, making progress on trade deals.
We're going to announce a whole bunch of deals over the next week or so. So the China deal, we inked the deal. I think we could get a deal done now. Europe will be right at the end.
More on Europe and on China in just a moment. China, what deal? Monica Guerra of Morgan Stanley will explain that in just a moment. Live from New York City this morning. Good morning. Live from New York City this morning. Good morning to you all. Heading towards the weekend. Just one more trading day to go. Very close to all-time highs. Your day ahead looks like this. 8:30 Eastern Time. Another data point for you. Core PCE. Look out for that a little bit later this morning. Personal income and spending data important as well. And then a snapshot of the economy and consumers. Or is it just a snapshot of how they feel about politics right now? UMich Consumer Sentiment. 10 a.m. Eastern Time. That's how the stage is set this Friday. Going into a market that looks like this Friday, following Thursday's price action, 0.05% away from all-time highs on the S&P 500 this morning. We're looking for record highs at the opening bell. We're up another 0.25% on the S&P. On the Nasdaq, up by 0.4%. Under surveillance this morning, we're making some progress on trade deals.
We're going to announce a whole bunch of deals over the next week or so. So the China deal, we inked the deal. That deal was signed and sealed 2 days ago. I think we could get a deal done now. Europe will be right at the end, but you got to remember, they're our largest trading partner, so the fact that they come at the very end makes some sense.
Here's the latest this morning. The U.S. Commerce Secretary Howard Lutnick indicating the U.S. has plans to reach agreements with 10 major trading partners after it finalized a deal framework with China. Joining us now to discuss is Bloomberg's Mike Shepard. Mike, what's the difference between a deal, an agreement, a framework for a deal? What has actually been agreed with China?
Well, it's a great question. It's the one we're all asking this morning here in Washington, and certainly in Beijing probably too. We're trying to figure out what exactly the terms of this are. We've gotten really from Howard Lutnick on our airwaves last night the broad strokes of what was agreed to between the world's 2 largest economies. And in essence, China is promising to remove some of the barriers on exports of rare earths, which are needed in everything from wind turbines to airplanes to night vision gear, all sorts of products across the economy. They will remove those barriers. And in turn, the U.S. will lift some of the restrictions it had imposed in the past few months on exports of certain technologies to China. That includes chip design software. It also includes shipments of ethane, which is a critical element in making plastics. So we're waiting for the two sides to actually follow through on what they signed 2 days ago. And Howard Lutnick made clear that the U.S. will only actually lift those barriers once it sees actual physical progress on the exports of rare earths to the U.S., to trading partners here, to companies that are looking to buy these elements, these rare earth magnets. This includes the auto sector as well, which has been complaining vociferously about a lack of progress in this area, John.
Hey, Shep, the market's moved on from a lot of this and moved on pretty quickly. You live and breathe this stuff down in Washington, D.C., in the nation's capital. Is it fair to say there has been a shift in the mood music over the past few weeks, less aggressive on trade, less aggressive on things like the revenge tax as well? Is it fair to say we have seen that shift?
We certainly are seeing something of a shift, and there was a recognition that the revenge tax really posed an issue for Wall Street and for businesses overall as they look at the U.S. and decide whether this is going to be a good place over the long haul to invest. Things like the revenge tax actually emerge as a barrier to that kind of investment, and the signaling on it really came very quickly from the investment sector, and that really prompted the Treasury Secretary and leaders on Capitol Hill to back away from that provision. It was a source of grave concern. And you're also hearing, when it comes to trade, John, Howard Lutnick indicating that he really is trying to reach a deal with the European Union. This is the largest U.S. trading partner. It is going to be a very tricky one. And remember, if they don't reach an agreement, the reciprocal tariffs on European imports into the U.S. will rise from the current baseline of 10% to 50%. So there's a lot at stake there. Even so, there are, as we heard from our colleague Oliver Crook in Brussels just now in the past hour, there are a lot of misgivings in the bloc about how they proceed and whether they're at risk of getting some sort of asymmetric deal with the U.S. Remember, while we're seeing a little bit of easing on trade and on tariffs, there is still the prospect of sectoral tariffs on whole categories of goods like semiconductors, pharmaceuticals, and lumber, John.
Hey, Shep, appreciate the update. Thanks for making time for us. Mike Shepard there of Bloomberg down in Washington, D.C. The language is different, no longer nasty. Do you remember that? Europeans are nasty. Nastier than the Chinese, apparently.
I was pretty taken aback and surprised on how nice the president was in terms of the European leaders when it came to NATO language, saying this is not a ripoff. These are people who love their country and we should help defend them. This is all part of the program. But when it comes to the European Union, this is going to be challenging because this administration is not just looking at trade barriers, looking at non-tariff barriers as well. But I know Shep is talking about July 9th, potentially those higher tariff rates come back. When I spoke to the Swiss trade ambassador, they said that they have been given reassurance after reassurance that if a deal is not there by July 9th, there will be extension. So the cans will be kicked.
A lot of deals to be made in the next few weeks. Monica Guerra of Morgan Stanley joins us around the table. Monica, good morning.
Good morning.
July 4th, July 9th. The 4th for taxes, all self-imposed. The 9th for trade. How are you setting up clients going into July?
I think I'm just really trying to focus on the positive, right? That we've passed that peak uncertainty a while ago now, where we have more known unknowns, more known knowns, and that we're going to get more clarity, right? As we're thinking about moving cash off the sidelines and back into markets. Now, for the 4th, one of the questions I get all the time, right, is are they going to do it? Are they going to make this deadline on the tax bill? And, in our opinion, we think we're going to get some text to look at. We'll actually have some movement in what the final Senate package is comprised of, and that, includes everything from, cuts to taxes. The other piece of this whole equation is on the, trade and tariff front. And so we're watching that, very closely like everyone else. But there are some interesting interplay between the tax bill and tariffs at this time.
To John's point, the mood music sounds better, but this seems like positive vibes. What is tangible? When the Commerce Secretary says they have a deal they signed with China, what is the United States giving up to get those rare earths? Do we really know?
We don't, right? I think we're all looking at sort of the black box right now, waiting as this information comes out. Even the rare earths information is fresh, right? If we're thinking about this morning and getting more as we go. For us, what we're looking at is more of those non-tariff trade concessions, like you're saying. We do think that LNG is going to be part of that discussion, as well as defense. So we think that we're going to have not just increased U.S. demand from future bills and spending, right, but also more export demand, right, for our for our stuff.
This is really important. The idea of what do these deal negotiations look like? It's not necessarily the traditional, you lower your tariffs, we lower our tariffs. It's, you know, if we lower our tariffs, will you buy this many Boeing airplanes plus this many B-2s and this many whatever else? And that's really a question. You think that there is a lot more to go in the energy space. Can you go through where that hasn't showed up as much in the price action, where you see that to really play out for the remainder of the year?
Yeah, I mean, I think right now, from a price action perspective, we are seeing, MLPs outperforming because that's part of the LNG story, right, as far as exporting and making sure that that's, moving in a smooth direction. We do think that there's going to be over a 5% increase in demand domestically this year. And then you have to layer on, right, all of the geopolitical factors around LNG specifically. The other thing that I like to hit home on, and this brings it back sort of full circle to the tax bill, is that the Inflation Reduction Act provisions are actually not being rolled back at the rates that were originally expected. And one thing that I've come on here and sort of pounded the table on and continue to pound the table on with clients is that clean energy continues to outperform traditional energy. This happened during Trump 1.0, underperformed during the Biden administration, now outperforming again. We do think it's part of a rate, but also this desire, a rate story, but also the desire, right, to keep oil prices low.
So this is also fascinating because it seems like we're playing whack-a-mole with different sectors. We were talking about the auto sector getting really hit by the tariffs. All of a sudden, GM and Ford were the main players. Are we shifting our focus increasingly to the energy space? We hear President Trump coming out saying, if you don't lower your prices, you're letting them win. You're going with the bad guys. I mean, we've heard this type of rhetoric, and yet a lot of people in the shale patch have been really hurting in terms of their profitability because prices have been low. What does this look like in the remainder, at least of this term, but even this year?
There's one of the things that I think is important if we're thinking about supply domestically. There's not much that the U.S. can actually do. So if we're thinking about tax credits or any kind of give back or break that the Trump administration could provide or Congress could provide, it's not going to be enough to actually incentivize more production. And so that is really important to hold on to, that this is a macro market and it is not, we have very little control. Now, oil prices over time have stabilized in the U.S., right, because of the Strategic Petroleum Reserve and other tools that we've used. But we have actually very little sort of moment-to-moment control over those prices. So maybe we get some reduction actually around the elections and midterms. Maybe that's sort of the moment where we see an actual decrease in costs materially for folks.
Monica Guerra of Morgan Stanley. Monica, thank you. Appreciate the update from you on two key deadlines going into the next couple of weeks. July 4th, we're looking for an agreement on taxes down in Washington. Then July 9th, we're looking for some agreements, and I stress some, on trade. Coming up later, just look out for this. Just a quick programming note for you. 8:15 Eastern Time. We're catching up with the Energy Secretary, Chris Wright. And I imagine you might have some question for Secretary Wright on energy and on this story a little bit later.
Well, there's this feeling you want to boost the energy sector in the United States, particularly with AI. And there was another story coming out of Reuters this morning about that at the same time that you're seeing rig counts go way down because prices aren't high enough to justify their production. So a real kind of conundrum wrapped in an enigma.
Is that what it is?
It is.
In a riddle? What's the next line?
Yeah, something like that. I don't know. I'm not doing well with
I forget. It's Friday. Whatever. All right. Secretary Wright coming up in about 50 minutes' time. Look out for that conversation. Up next on the programme, David Mericle of Goldman Sachs. Plus, Danny Berger with your morning movers. Estee Lauder rising on an upgrade from HSBC. We're looking for record highs at 9:30 Eastern Time at the opening bell on a US benchmark. Equity futures right now adding some weight to the recent rally, up another third of 1% on the S&P 500. On the Nasdaq 100 up by 0.4%. This is a big tech-led rally. Michael Hartnett of Bank of America saying the participation has been really quite small. Only 22 S&P 500 stocks currently at a record, even with the index within striking distance of all-time highs. Something to think about the index level. Beneath the index, some single names for you. Your morning movers with Danny Berger. Hey, Danny.
Hey, John. If you're worried about breadth, we do have some consumer stocks outperforming this morning. Nike, one of the best performers in the S&P pre-market, down up 10 0.2%. They had earnings yesterday. They beat expectations. Yes, they had a drop for the current quarter in their forecast, but less than expected. The hope is that the worst is behind Nike, that the CEO has done enough work turning around this company, focusing on sports, getting down their inventory to right-sizing that so those shares rallying. Also, another consumer stock on the up this morning is Estee Lauder. Those shares up 2.6%, an upgrade from HSBC. Three things going on, say the analysts there. One, consumers in China are normalizing. Two, a weaker dollar. And three, continued American resilience. So that helping the shares this morning. Meanwhile, Lisa mentioned this story before the break. Reuters exclusive reporting that according to sources, the Trump administration is looking at helping more power supply getting to the big AI players. That means things like making it easier for some of these energy names to connect to the grid, the use of federal land for AI data centers. So again, all the energy names up pretty sharply. Constellation probably the best this morning, up 2.7% on that story, John.
Danny, thank you. More from Danny in the next hour. Just a repeat programming note for you, 8:15 Eastern Time. The Energy Secretary, Chris Wright, joining us on the program in about 44 minutes from now. So look out for that conversation. We're behind on this, aren't we? How many times have we been told we are behind, making sure we've developed energy infrastructure to such an extent to back up what we're already seeing in capex from the major tax players?
Yeah, and you wonder what that form that's going to take. New York State talking about somewhere in the state having a new nuclear plant. Is that going to be one of the paths of travel as we see a 3-point mile getting regenerated? And this question of how are we going to power something that clearly is powering the stock market and powering a lot of the exceptionalism dreams for the United States?
We'll pick up on this program now in just a moment, about 45 minutes away, a conversation on energy with the administration. On our radar this morning, one of our top stories, the US and China reaching a trade deal. China echoing Commerce Secretary Howard Lutnick, saying a trade framework is on the table. Lutnick also telling Bloomberg the White House has imminent deals with 10 major trading partners.
So when it comes to the 10 major trading partners, the president mentioned India yesterday. So maybe that's one of the first few. And then Howard Lutnick, the Commerce Secretary, is talking about how the European Union, obviously they need to get a deal done, massive trading partner for the United States, but it might be one of those deals that gets done a little bit later or pushes down until later into the summer. When it comes to China, I'm still scratching my head. Exactly what did they sign? Who signed it? Is just what they discussed in Geneva and London? That's not exactly a trade deal. It's an understanding on a few issues, rare earth minerals, and then what is the United States giving up in lieu? The Chinese side said the U.S. side will correspondingly cancel a series of restrictive measures taken against China. Well, which restrictive measures?
There are a lot of questions. There are more questions than there are answers. I do think, though, the salient point here is something that you've mentioned several times, John. The mood music has dramatically changed. It's gone from eat your vegetables to maybe let's start talking about candy. And that really is the question, not only the tax deal, but also this question of what industries are going to benefit from sales to other countries that are part and parcel of these deals. I mean, I really think that's where people's minds are, as it does seem like this is a escalate to de-escalate type of mindset.
As soon as you got that 90-day pause from trade, for many people in this market, the story was over. As soon as you started to see the Treasury Secretary, Scott Bessent, in front of the camera a whole lot more than other people, for a lot of people, this story was over. And I remember you being on Air Force One and saying it almost immediately. At the start of the weekend, it was someone else standing behind the president. By the end of the weekend, it was the Treasury Secretary, Scott Bessent. And by that point, this story was over.
Yeah, Friday, Washington to Mar-a-Lago. Commerce Secretary Howard Lutnick was standing behind the president on Air Force One. And then Sunday evening, and this was just days before he came out and said, we are reversing the Liberation Day tariff rates. It was the Treasury Secretary, Scott Bessent, standing behind the president on Air Force One, who, by the way, gave an interview earlier that day in Washington, so flew down to have a conversation with the president. And clearly the president was annoyed that day about anyone talking about the markets or asking about trade, probably because he knew he was going to have to make this decision to unwind his Liberation Day.
And here we are 20% later, 20% plus later on the S&P 500. Geopolitics getting better as well, even though Iran denies that nuclear talks with the US are scheduled for next week. The foreign minister saying, quote, speculation about the resumption of negotiations should not be taken seriously. Elsewhere, the supreme leader claiming Iran won the war.
So they certainly didn't win the war, but when you hear from Abbas Araghchi, the Iranian foreign minister, he says there's no agreement, arrangement, or discussion. The president on Wednesday, I was with him in that press conference, said that we, the United States, will be speaking to Iran next week. So now there's a question of whether or not they're going to meet or not. More interesting, more important to the story, the Iranian foreign minister says they do not currently intend to host the IAEA director, Rafael Grossi, and that they will not, at this moment, adhere to the request by the IAEA to come look at the nuclear facilities. That is a problem.
That is a major problem that we'll have to ask questions about of this administration about how they intend to proceed from here. One more smaller story I want to squeeze in. Trump's big, beautiful bill hitting a snag in the Senate. A GOP plan to cut $250 billion in Medicaid and other medical spending deemed ineligible for special procedural maneuvering by the chamber's chief rules keeper. Can you make sense of this for us?
Basically, if you go through this process of reconciliation, it needs to go to this nonpartisan parliamentarian, and they go through every single provision and see if they can use reconciliation to get these policies through. And right now, the parliamentarian, as late as yesterday, was knocking stuff off the list and saying, you're going to have to go back and find a different way to find some of these spending plans or tax cut plans because this does not pass the muster test. The fact of the matter is the parliamentarian is still analyzing their bill, which is why everyone's looking at this and saying, I don't see how this gets done by next Friday.
So I went down a rabbit hole this morning on Elizabeth McDonough, who is the parliamentarian and was actually put in that position in 2012 by a Democratic president, but then reinstated. And here's this person, career lawyer, and she's at the epicenter of absolutely everything and might actually put the kibosh on a major offset to the spending plans. I love this story. It's great.
How do you choose which rabbit hole you go down in the morning?
It just is sort of a natural phenomenon. That was my
just come in and
this morning.
That was this morning.
Yeah, because it was like, who is this person?
She has a lot of power.
She has a lot of power. How does she wield it in a way where she isn't just outright rejected? Because she could be.
I'm sure some people feel like she's got too much power. This morning, at least. Counting down to inflation data in the next hour, just ahead of the payrolls report next Thursday. David Mericle of Goldman Sachs writes in this. Soft data have tended to signal that the economy is slowing earlier than hard data, and the hard data might take even longer than usual to weaken. David joins us now for more. David, welcome to the programme. It's good to catch up with you. Let's just pick up on that last line. Why will it take longer than usual to weaken this time around?
There's been a lot of front-loading of both imports and consumer spending that I think could flatter the hard data for a little bit longer than usual. But most of what we're getting at there is just that historically, when something goes wrong and the economy weakens, you tend to see it faster in business surveys than you see it in the hard economic data. It's a problem at the moment because many investors feel like the business surveys misled me a few years ago. They told me there was going to be a recession in 2022. People are reluctant to look at that information, but I think actually what companies are telling us is pretty informative about the impact of the trade war and the impact of policy uncertainty so far. Consequences to us look, limited, but there are some.
All right, so what are those consequences? And you say limited. Is this basically we're going to get some pass through to consumers, we're going to get some absorption from the exporters in other countries, and it's all going to be manageable and just lead to keep carrying on?
That's right. So far in surveys, companies have indicated that the pass-through they anticipate at this early point to consumer prices is a little bit less than we think we saw in 2019. So the direct pass-through, companies are putting it around 50%. Our estimate of that from the first experience, closer to 70%. So, definitely would show up in prices. We think there will also be spillover effects. If an American business is protected from foreign competition by tariffs, they might also raise prices, but looking a little bit more moderate. And if prices don't go up as much, that means the hit to real income isn't quite as large, and the hit to consumer spending might be a little smaller. On capital spending, I think companies are being a little bit more cautious, especially those that think they will be more affected by the trade war or by policy uncertainty. But the aggregate effects look manageable at this point.
So this raises a question, and I've been a little flippant, overly so, about, tail risk on, tail risk off, this idea that a lot of the biggest fears are over so people can just keep moving on. There have been some substantial structural changes. Tariffs are a reality. Companies are going to be challenged to find new supply chains potentially. How much cost gets baked in and how much comes out of profit margins in a way maybe people haven't appreciated?
Yeah, if it's not going into consumer prices, it is coming out of someone's profit margin. The surveys of businesses suggest that foreign exporters are not absorbing much of it. So to the extent that it's not passed on to the consumer, either the wholesaler or the retailer or somebody along the way is going to have to absorb that hit. And it is a tax hike, and that would reduce profit margins. In terms of supply chain impact, I don't think a 10% tariff forces you to do things radically differently. Some of the larger tariffs, 25% on some items from China, Tariffs are now as much as 55%. That might make companies look a little bit harder for alternatives where they don't have to pay those tariff rates. So far, what we're seeing is companies are very focused on supply chains in management commentary, but they're not really talking about the sort of shortages that we saw during the pandemic. And I think that's very important because that would have had a large negative incremental effect on GDP and could have had a large incremental positive effect on inflation. So dodging that bullet so far is a relief.
In the face of potentially higher tariffs, though, are any companies talking about layoffs?
Not so much. We have seen a little bit of a tick up in companies talking about hiring freezes, not so much on layoffs. I would say the jobless claims numbers, after adjusting for some problems with the seasonal factors, aren't really showing anything that spectacular. I do think it's right to say that this is a difficult hiring environment for those who are currently unemployed. The rate of reentry into employment, their probability of finding a job, is low, more 2016, 2017 levels than 2018, 2019 levels. So there are some signs of softness in the labor market. It's a tight labor market. Job openings still pretty high, although coming down a tiny bit since the trade policy uncertainty kicked in. But we're not seeing a big spike in layoffs.
Which is why this Federal Reserve thinks it's got time to figure things out. David, appreciate the update from you and the team, sir. David Mericle there of Goldman Sachs. Are we managing to work through and avoid a tariff-fueled inflation bump, or did we just work through a bunch of inventories and we're going to see that bump in the months to come? This is the same debate we've had over the last month. I don't think it's changed that much going into the summer.
I would agree, except that it does appear that members of the Federal Reserve are coalescing around one particular scenario. And San Francisco Fed President Mary Daly yesterday was talking about that to us, about how she sees sort of three scenarios: the pass-through, and then the ongoing inflationary bump, a disinflationary, deflationary bump because of a slowdown in growth, or just one-time price shock and then everybody readjusts. And that's what they seem to be leaning toward. And that's the reason why they're opening the door to potentially cutting rates in response to just a little bit of weakening around the
What's the difference between July and September? What's the difference?
The
Couple
weather.
of months. The weather?
Well, it's just a little bit more data, and also probably to understand exactly the point that you raised, which is how much actually gets passed through in terms of when they actually have to start importing this stuff and paying it rather than just sort of stockpiling old stuff that didn't have the tariffs on it.
You've got Jackson Hole in between in August. That could be the pivotal point.
Yeah, talking about the labor market, talking about going forward. Maybe they'll say, we're going to cut rates by 2 times, and then we're going to keep on carrying on.
Just a 5-minute speech.
Yeah.
We're going to cut next month.
So there was the pain speech. Then there was the, we're doing what we're doing speech.
I stopped paying attention after the pain speech. Yeah.
So what's it going to be now?
No idea.
The joy speech?
No, it depends on the data. They're data dependent, although some people might say they're data resistant at the moment.
Yeah, people can throw a lot of shade at them. We don't know. This is a very difficult time. There's a real economic debate right now.
Equities are doing better, up and around a third of 1% so far in the S&P 500. Very close to all-time highs on record high watch at the opening bell at 9:30 Eastern time. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Back with us, here's Yahira. Hey, Yahira.
Hi, John. We start with the latest on Andrew Cuomo. He apparently is not quitting the New York City mayor's race. Sources tell us here at Bloomberg he will be on the ballot in November as an independent, despite pressure from donors and advisors to drop out. It comes after Cuomo's stunning defeat in the first round of the Democratic primary by Democratic socialist Zohran Mamdani. Meanwhile, Trump Mobile quietly removed online references that promised its first cell phone would be produced in the U.S., according to The Verge. The page now says the T1 phone would be, quote, designed with American values in mind. And the screen is now advertised as slightly smaller than it was previously. And Uber is reportedly in talks with founder Travis Kalanick to help fund his bid to buy the U.S. arm of Pony AI. That's the Chinese self-driving firm. The New York Times is reporting Kalanick would run Pony if the deal goes through, while also leading his current company, Cloud Kitchens. Kalanick, of course, was ousted as CEO of Uber back in 2017 due to a series of controversies. That's your Bloomberg brief. John?
Yahira, thank you. Appreciate it. More from Yahira in the next hour. Up next on the program, optimistic about a deal.
You could get a deal done now. Europe will be right at the end, but you got to remember, they're our largest trading partners.
We are ready for a deal. At the same time, we are preparing for the possibility that no satisfactory agreement is reached.
So what are companies doing right now? We'll get that view from Marissa Adams of HSBC joining us in just a moment. So these two Fed meetings bookend in the summer, July 30th, September 17th. And I said, what's the difference between the two? This is what Mike McKee's got to say. By the July meeting, the Fed will have just one more inflation report, CPI for June. By September 17th, they'll have three: June, July, August, and a lot more time to gauge the impact of this trade debate.
Three makes a trend. We always say that, right? You need three examples of something, and so three reports will definitely give them that confidence.
See you in September. Take the summer off. Seems to be the view of Mike McKee.
Sure,
We'll catch up with Mike later on this morning. Equity futures look like this morning. Positive across the board on the S&P 500, up a third of 1%, within 0.05% of all-time highs at a close on the S&P just yesterday, within striking distance and looking for them at the opening bell at 9:30. We're looking for an all-time high. Under surveillance this morning, optimistic about a deal.
I really feel I'm optimistic. I think we could get a deal done now. Europe will be right at the end, but you got to remember, they're our largest trading partner, so the fact that they come at the very end makes some sense.
We are ready for a deal. At the same time, we are preparing for the possibility that no satisfactory agreement is reached. In short, all options remain on the table.
It's the latest this morning. The White House announcing imminent plans to sign trade agreements with 10 countries, with the focus now shifting to the European Union. Marissa Adams of HSBC staying constructive, writing, "We have entered a new era for trade. We don't expect things to go back to the way they were." Marissa joins us now for more. Marissa, good morning. It's good to see you.
Good morning. Thanks for having me.
You've said this before. Trade doesn't stand still, but it has changed. Can you just walk us all through how it's changed?
Yeah, and it's really interesting because we did see disruption through the pandemic. We've seen a different period of negotiations, but really post April 2nd, it's changed the dynamic both on the supply side and the demand side. Now, we see these 10% baseline tariffs that are now in place, and I think it is really clear. I always want to keep reminding people they're there. So whilst we have a lot of negotiations, 10% is actually in place. But what's really changed is the speed of negotiations. And, we've heard this morning around the China deal. The Indian trade negotiators are in D.C. this week. There's optimism around an EU deal. And I think that this is actually quite a positive sign that quite quickly we're looking to come to agreements. Now, I would say they're deals in principle. They're not free trade agreements. And free trade agreements, as we know, take 5, 10, multiple years to really get down to the nitty-gritty detail. But at least this is a positive sign that we're getting to some certainty for corporates.
What are you seeing from individual corporations at the moment? What are they doing? We've been having this debate with economists, and maybe it's better to have this debate with you. Are you seeing them take the hit on margins, pass it on to consumers, something in between? What are they doing?
So it really depends sector by sector. And I think the one industry where we've seen it the most is in consumer retail. They have shorter order cycles. The lower margins. So what we're seeing there is that some of them are actually taking a hit to their bottom line. We've seen a few companies come out this week around that. The numbers, though, still are fairly small. And I think 10% is something that corporates can absorb. When it starts to get to 25, 30, 40, 50, that's at a stage where even if you want to compress your margins, you are going to have to pass costs on to consumers.
How much confidence do they have in terms of where tariffs are going to be the highest, i.e. China, that they're actually moving production? How quickly is that happening?
And it's a really good question in the sense that it depends if you are a shorter industry or a longer order industry. So we've seen in the tech industry, as an example, a lot of investment in semiconductors here in the United States. But a factory isn't built overnight. So we've got those commitments there. But 5 to 6, 7 years to build a factory, you're only going to do that once you know there is a certain path around how much more it will cost to come onshore. And again, margins is key. So some of those high margin tech businesses and the OEMs, they can afford to come back to the U.S. If you're in the ones that are a little bit narrower, you're still having to compete with OEMs in Asia for the ultimate end game. So that's where it becomes a bit of a challenge. So we've seen movement, and even over the past 3-4 years, there was a lot of movement into Latin America, into Canada's trading partners. But even that is still 5, 6, 7 years away from really being fully up and in production.
John alluded to this earlier, and it's a really good point. The idea that ahead of any kind of tariff, there was a stockpiling of goods at prices pre-tariff. And so we haven't really seen the ramifications either when it comes to margins or when it comes to consumer pricing. When does that run out? I mean, how long is that runway?
Yeah. And Q1 data, actually, you look at the Q1 data, really strong results. The WTO trade index at quite a significant high that it's seen. And And that is really due to that front loading. I think we'll start to see some of the effects in Q4, but industry by industry. So if you look at the healthcare industry, I've been in New York this week speaking to a lot of pharmaceutical companies, and they have long-term contracts. So they are locked in for a year and a half, 2 years for some of that production. So they may not actually see it for quite a time. Same thing with the energy sector, where you have long-term energy sector contracts. But anything that is shorter order and where they're able to adjust, they will. Now, one of your guests earlier was talking about the fact that exporters don't really seem to be taking the hit at this stage. That also might start to change, because as you're starting to negotiate with those suppliers, is there a stage where you sort of, you've got to get them to lower their prices a little bit to offset the tariffs. So I think in Q4, we'll start to see some of those effects.
The political sell, though, for tariffs is to bring manufacturing not to Canada or Mexico, but to the United States. Is 10% getting it done?
It's starting to create those conversations. And I think in addition to, it's not just tariffs that's an impact. If there's tax incentives, if there's other regulatory incentives. Now, the other thing that is hasn't necessarily been expressed here is also about resiliency. And we saw after the pandemic, corporates were really focused on resiliency. How do you get those items actually into the country? So there is a huge benefit. In the healthcare industry, for example, they have already done region for region. So where they are supplying medications here in the United States, they've actually brought that production on shore. So it is really starting to happen. It's just that it's a little bit longer of an order cycle, and they need some more incentives to actually make that investment.
What about the sectoral tariffs that we're potentially going to get when it comes to things like pharmaceuticals that are also going to be on what many would say more sound legal footing?
And that, I'd say, is more of a concern for corporates than the 10%. So where those land and how that means they have to rejig some of their supply chains is going to be a challenge. So they're looking at that. What I would say is that the biggest challenge at the moment is still this uncertainty. So you don't want to make an investment. You're waiting to pause to move through that. And as a result of that, companies are delaying decisions. There's only so long you can delay. Now, I can't tell you whether 3 months is okay, 6 months is okay, 9 months, but we will start to see that. And that is a challenge, especially if you want to move supply onshore and also create more production capabilities in the United States.
Just quickly, how has your business changed? How have you and the team had to innovate? What kind of solutions have you had to come up with for corporations?
So great question. Thank you very much for that. I appreciate it. And we are having to do 3 things. So the first thing is really doubling down on working capital. Treasurers and CFOs, I think over 6-7 years ago, were lucky, a little bit blessed in a low interest rate environment with less volatility. But now they're looking for more tools in their toolkit. So we're looking at ways to help them finance receivables, payables, inventory as well. So inventory finance is a relatively new product area where, again, you weren't having to hold so much on shore. Now you are. The second area is around services. So services trade is 26% of global trade. It's growing at 3 times the rate. And actually, we're seeing a lot of traditional goods manufacturers going into services trade. So we've started to create contract monetization facilities for that, financing those long-term contracts that, again, are not traditional goods trade, but actually it is an exchange and trade of information.
You've got 10 seconds to tell me the third one.
The third one is we are working with them on how they look at new corridors. So I think HSBC, we're in over 60 markets. We have local presence with their suppliers, so we're helping them to advance in new markets.
Perfect timing. We'll continue this conversation. I'm up against a hard break, so we've got to go. But it's good to see you. Thank you. Thank you very much. Marissa Adams there of HSBC. Up next on the programme, Judy Biel of Kayne Anderson Rudnick, the US Energy Secretary Chris Wright, Alejandra Grindal of Ned Davis Research, and Gennadiy Goldberg.
What moves the market is uncertainty. Tariffs are certainty at this point.
The marketplace has absorbed the idea of a 10% plus or minus tariff. The market has absorbed that and moved on.
The markets might overreact between now and September, October.
You're guessing what the center of the economy is. Overall, the consensus looks like to wait and see.
What we're looking at is probably a little bit more risk of a melt up.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The third hour of Bloomberg Surveillance starts right now, and your scores look like this. Live from New York City this morning. Good morning. Equity futures positive once again, up by 0.4% on the S&P, near session highs, up by 0.5 on the Nasdaq 100. You know the numbers by now. Within 0.05% of all-time highs on the S&P. We're about to hit them at 9:30 Eastern Time. An hour before that, we're about to hit this. 8:30 Eastern Time, some economic data. Core PCE. Another read on inflation for a Federal Reserve that is looking increasingly divided going into July.
And the expectation is for the ongoing disinflation. In other words, numbers that give the Fed a reason to cut because the inflation is coming down. Although some people would argue they are forward-looking mechanisms. They have to look at what the effect of the tariffs has been, and that has been the argument for them. We also get personal income and personal spending. And on some level, that might be more interesting. Are people actually cutting back their spending in response to some of the potential price hikes on the heels of tariffs?
We've seen some of that softness start to come through the economic data. I think you can say we saw it earlier this week in consumer confidence. When consumers are asked at the moment, do they see jobs as being plentiful? We're seeing fewer consumers right now that believe that. When you look at jobless claims, things got better this week. But continuing claims speak to the idea that if you're not with a job right now, if you're without a job, it's harder to find a new one.
Yeah, it's hard to be overly rosy about the economic backdrop when you're looking at continuing claims at the highest level going back to 2021. This means it is a very difficult market once you are out of work to get back in relative to where it has been over the past couple of years. What people are coalescing around is there isn't that tail risk that's going to torpedo the U.S. economy into recession. Companies are adapting and adjusting, and consumers feel bad, but they're not exploring that when it comes to actual behavioral shifts. And that, I think, is what people are getting enthusiastic around, plus the fact that AI spend continues.
True. Another read on the consumer later on this morning, then. Look out for UMich consumer confidence. Another read on the labour market next week on Thursday. Remember, Thursday is the date for the payrolls report. It's a holiday on Friday. Might not be a holiday for those of you down in Washington, D.C., because there is a key self-imposed deadline. July 4th, Independence Day. They're pushing to get this tax bill passed.
Quote, we hope, is how the president put July 4th. We hope that we can get the one big beautiful bill done by July 4th. Look, this gives them a week to basically finalize the text, an agreement in the Senate, then go back to the House, where it's going to be challenging for some of these House members to agree from the edits from the Senate and then get it to the president's desk. Of course it could happen. Is it unlikely? Yes.
They're saying all the right things at the moment, though.
They
saying
are,
all the right things on taxes, on trade, too. Can you explain to the audience what the agreement is with China? Do we know?
The agreement with China, well, we don't have the text yet. We don't know who signed it. But the agreement is in reference to the talks in Geneva and in London about the issues of rare earths and those licenses coming from China and some of the export controls, revoking of student visas from China, potentially from the United States. But again, we don't know exactly what the U.S. decided to unwind to get this framework that they said they signed this week. The president said that, and so did the Commerce Secretary.
The market doesn't care about the details. Just seems to care about the mood music, and the mood music has improved.
Yeah, and honestly, at this point, no one's expecting to get details. Let's be really honest. Does anyone actually get to expect answers to all of those questions in a deal?
I'd like to read it.
Sure. You also said that maybe it's not going to be a vacation, John, for people down in Washington, D.C. Let's make vacation great again. I just think that we should start that motto. I mean,
sounds European. No thanks.
Shots fired. Who at?
Not sure. I personally stand by it.
Sometimes, you're in Europe for 2 days and you're like, wow. They just don't have the same, as Eric Adams would say, focus and grind as America.
Do you want to carry on?
That's it.
Look, I've been here for the best part of a decade now. I love this country and the American work ethic. And when I go back to Europe, I do feel like there's a real divide between what the Americans do and what the Europeans do. I'll leave that there. But to your point, you're back for like 2 days in the summer, and I'm like, they've got this down. This is the way it should be done. Take August off. Just take the whole month off. Shut it down. Just close the market.
I've already basically booked it. So, see ya.
You're not getting a good exchange rate.
117. It's not too bad, is it? It used to be like 140.
I know.
10 years ago. Anyway, $1 at the moment, 117. Equity futures up by 1/3% on the S&P. Coming up this hour, Julie Biel of Kayne, Anderson, Rudnick with stocks on the brink of record highs. U.S. Energy Secretary Chris Wright as President Trump changes his tune on Iranian crude. And Alejandra Grindal of Ned Davis Research reacting to the latest read on inflation. We begin this hour with stocks higher on trade deal optimism. Julie Biel of Kayne, Anderson, Rudnick writing the looming deadlines on trade and the budget can create a ton of volatility in the market. That makes it a nice time to add some quality to portfolios. Julie joins us now for more. Julie, welcome to the programme. Just kind of framing July, going into the 4th, going into the 9th. Had a guest on earlier that said get ready for some volatility. Do you agree with that?
Yeah, I think there's a lot of potential. We know that when we've had big movements in trade deals, that it does create a lot of volatility. It does create a lot of noise. And I appreciate that, the Trump administration has talked about, the deals that they've signed, but they're MOUs, they don't have a lot of teeth, they don't have a lot of details, and it's very hard to feel, if you're a business, that you can really plan around these 90-day increments. And so I think that what you'll see is quite a bit of movement in terms of inflation data, employment data, and eventually earnings. Those will come back at some point.
So if we could just frame the past 85 days, we've seen this whole round trip in equity markets from record high to 20% lower to record high again. What has really changed? How much have we seen just the idea of extreme negotiating tactics, then taking off the boil, maybe being a little bit more sanguine about the risk? And I'm talking about the White House, faced with the backdrop of a U.S. economy that keeps chugging along with a little bit more weakening around the edges, but the AI story is still intact. Basically, not that much has changed. Can we say that?
I think you can absolutely say that. I think really genuinely not that much has changed. No company really can feel super confident making large decisions in their supply chains right now because it's just too much uncertainty. So what you're seeing are these weird bolus where if you check the ports data, right, and you see the shipments coming in, you see these huge movements where up and down, and that creates a lot of friction within our supply chains, and that adds costs. You don't even need a lot of inflation or tariffs to create that. You're just creating a lot of inefficiency. And so someone has to pay for that inefficiency, right? Someone has to pay for the tariffs in the same way. And I don't think that's super reflected in valuations overall, particularly for companies that have more cyclical sensitivity.
So can you give us a sense of how you're understanding the progression of this trend of people not fully appreciating the cost of those frictions in the data that we're going to be getting? In about 23 minutes, we're going to be getting personal income and personal spending. Do you expect to get the first signs of that by consumers retrenching or their incomes coming down? I mean, can you see it in the personal balance sheet yet? Or is this something that isn't going to materialize for, say, 6 months?
I think it's actually going to take time, right? Because you're seeing the income effects that are playing out at different levels. So for the low-income consumer, we are already seeing the stress. We can see that in a lot of the dollar store commentary and Walmart's commentary. We know that there's stress there. Strategas does this great analysis of Google searches in terms of bankruptcy and personal loans, and they've seen a real increase in that. And that's concerning to me, right? Because you can't really fix a lot of this balance sheet situation with more debt. And so I worry that we're getting to a place where consumers are feeling a little bit stressed and they're not really able to get in and out of the housing stock with interest rates where they are. So it's hard to see where they're going to get the level of relief that they need. And when we have an economy that's really driven by the consumer, that also makes it difficult to drive a lot of earnings growth.
Do you think we're going to finally at some point see whether or not it was just front loading of individuals buying up a bunch of materials?
I think it takes time. If you listen to businesses talking about the front loading effects, it's really hard to know exactly when and where those are. You have a lot of inventory that's actually being held at the ports because companies aren't sure when to take them, right? So there was a whole blow up of inventory there. And eventually people recognized, okay, I'm going to take it because the tariffs on China have gone down. So it's very, very difficult, and there's going to be a lot of noise. I think we were expecting, okay, the noise is going to quiet out through the summer, and now I'm not so sure. I think fourth quarter is actually when you're going to have a much better sense of what the true run rate and the earnings power that is underlying a lot of these businesses.
You've been so focused on tariffs and what's going on with trade. When you hear the Commerce Secretary say we signed a deal with China, is that noise to you?
Yes. I mean, we still don't have a lot of clarity on terms of what these agreements are, right? Like, I have an MOU with my wife that I'm not going to drink too many margaritas tonight, right? That doesn't mean that that's actually what's going to happen. And I think that's the problem with these MOUs is we talked a lot about them happening before in terms of the rare earth minerals, and then we hear, oh, actually, no, those are being withheld. So it's really hard to feel like you can sink your teeth into a lot of the deals that are being struck because they keep seeming to walk back and walk forward from them.
I promise we'll let you go in just a moment so you can get started early. But just one more question, Julie, okay? What's your approach to the next couple of months? Where do you want to be in this equity market? Would you fade the gains we've seen in big tech, or do you want to stick with it?
I think that there's still really good, strong secular growth that's happening in big technology. And so to me, you can continue to hold positions where valuations aren't too overly stretched. But I think you want to be adding some more defensives in terms of healthcare stocks or very high quality, financials and things. That's really where I think you want to be, is to have some real earnings durability that you can feel confident about, because I do think that there is less clarity to earnings progression over the next 12 months than we've had previously.
Judy Biel of Kayne Anderson Rudnick. Judy, cheers to that. Enjoy yourself. All right, just for the record, this is just warm water.
No one thought
all right?
that it was
There's nothing
anything
else in that. All right. But when TK was on the show,
never knew. As a viewer, I never knew.
when TK was here,
Could make Fridays fun.
just a bottle going around the table.
Oh,
at
yeah,
times,
big time.
You know? All right, let's get you an update on stories elsewhere with your Bloomberg brief. Here's Yahara with more. Hey, Yahara.
Hi, John. A trade deal between the U.S. and China was signed 2 days ago. That's according to Commerce Secretary Howard Lutnick. In an interview with us, he said the deal codifies the terms laid out in earlier talks, including China's commitment to deliver rare earth minerals. We also heard from China this morning, which also confirmed the framework. Meanwhile, a bright fireball lit up the skies over the southeast on Tuesday, and it's believed to have been a meteor. People across Georgia and the Carolinas say they saw it streaking overhead with smoke trailing behind it, followed by a loud boom. One fragment reportedly even came crashing through the roof of a home in Atlanta. And this story is finally getting its own brief. Wedding celebrations are underway in Venice for Amazon founder Jeff Bezos and Lauren Sanchez. But the event has reportedly been relocated to a more secluded part of the city to avoid protests. While details remain under wraps, the guest list is set to include up to 250 people, with the festivities reportedly costing as much as $55 million. A drop in the bucket for Mr. Bezos. That's your Bloomberg brief, John.
Yahara, thank you. Unbelievable. 55 million. 250 guests.
Yeah, I was looking at that, and I was looking at the outfits and the different people and coming in.
55 million is a little grotesque for a wedding. I'm sorry.
You've got something to say.
You're
looking at the outfits.
You didn't like her Skipperelli outfit?
What didn't you like?
Well, it wasn't that I didn't
There's
like
a vacancy
it.
at Vogue now, so this is the pitch. Go.
Okay, it's just that trend where you make your waist disappear. I don't understand physically how that happens.
The Victorian era trend?
Yeah, like the corset. But it's really, it's reached some extreme levels, and let's leave it there. And
Looks uncomfortable.
I know. At the same time, it's just sort of a medical marvel.
Would you like that position over at Vogue?
It's couture Skipperelli. It's not a medical marvel.
Nobody wants
we
to
know
see
who
that,
it is.
John. How can you
Take
imagine?
over from Anna Wintour?
Yeah, that would go down.
Sign me up.
That'd be cool. All the tickets she gets to go to all the good stuff.
Oh, it'd be totally cool.
Every sporting event, I always see her at the tennis.
Except everyone would be wearing your nothing.
And the clothes. You get all these free clothes.
That's true, you get free clothes too. All right, futures up by a third of 1%. Up next, the Morning Calls Plus. The US Energy Secretary Chris Wright, as the president pushes for a shift in global energy. That's next. This is Bloomberg. Just in case you were interested, the conversation on the Bezos wedding continued for the last 2.5 minutes. Are you both finished now?
We're done.
You've settled this, okay?
We'll talk more Monday when we see who made the wedding dress.
Do you know who made the wedding dress?
No, I don't.
Got an idea of what it looks like?
I have my idea.
I think we've got a decent idea of what this is going to look like.
Based on her past dresses.
Choices. Okay, all right.
Including at the White House.
Let's move on.
Okay, I'm moving on. You guys didn't move on at all. All right. Equities are positive by a third of 1% on the S&P, up by 0.4% on the Nasdaq 100. We're high here across the board. In 1 hour and 13 minutes time, we're on record high watch, expecting to breach the all-time high on the S&P 500. Went through it briefly in yesterday's session. At the close, though, just short by 0.05%. That's the price action. Here are some morning calls for you. First up, HSBC upgrading Nike to buy, saying its margins will be, quote, repaired despite tariff risks. That stock is flying, up by 10.4% this morning. Your second call from Cantor Fitzgerald, raising its price target on Uber to 106, expecting autonomous vehicle developments to drive share performance. That stock is up by 0.2%. That's an interesting perspective. And finally, Baird downgrading JP Morgan to underperform. The firm not expecting the same level of returns as the last several years. That stock is down by 0.5%. Let's turn to energy. The US changing its tune on Iranian crude. President Trump Posting on Truth Social earlier this week, China can now continue to purchase oil from Iran. Hopefully, they will be purchasing plenty from the US also. Joining us now to discuss the state of energy, not just domestically, but worldwide, the 17th United States Secretary of Energy, Chris Wright. Mr. Secretary, welcome back to the program, sir. Looking forward to an in-depth conversation with you about what you cover every single day. So first of all, just on Iran, so we can deal with that, what is the current stance of the US officially on the use and import of Iranian crude?
Oh, the sanctions are still in place. No change there. I think what President Trump was referring to there is, hey, if we make a large peace and sanctions come off, Iran can flourish.
Have you got a decent understanding, though, Mr. Secretary, of just how much Iranian crude is being consumed and imported already as things stand, despite the sanctions?
We do. So Iran produces about 3.5 million barrels a day, and they've been exporting about 1.5 million barrels of oil a day. And the maximum pressure campaign that President Trump did in his last term tamped that down to only 100 or 200,000 barrels a day. They cut off 90% of it. That was a possible strategy here as well, but hadn't been implemented yet. We tried to give negotiations a chance, see if we can do it without maximum pressure.
So is maximum pressure still on the table, or is the administration walking away from that?
Well, the goal right now, of course, is to get a peace deal, is to get peace into the Middle East and spread the focus on commerce, not conflict. So, no, it's not actively being discussed right now, but the situation's still dynamic there. We want to see peace, prosperity, and security as the future of the Middle East.
When it comes to what's going on in Iran as well, in terms of the IAEA, the foreign minister said yesterday that basically they have no plans to having the Director General, Rafael Grossi, in Iran. And it doesn't sound like they're willing to give the inspectors the space, time, and access they need to look at these nuclear facilities. What is the United States' response to that?
Yeah, look, this is early on. This is early on. Iran has just had most of its nuclear program entirely devastated by Israel and the United States. They're a little bit humbled. They're a little bit shell-shocked right now. So, yeah, I wouldn't put too much weight on those words, but a final peace deal certainly has to have confidence in a dismantlement of the Iranian nuclear program and that people can have security it won't be resurrected in the future.
You deal with a lot of nuclear at the Energy Department. Before the U.S. strikes, but after the Israeli strikes, Rafael Grossi told us that the IAEA cannot verify whether 400 kilograms of 60% enriched uranium in Isfahan was currently where it was. Was it still there, or did the Iranians take it out? Doesn't the IAEA need to go in and verify where this enriched uranium is?
I think that's quite likely part of a future negotiation or a future deal.
Mr. Secretary, of course, this is just one part of the conversation in energy right now. I can tell you earlier on this morning, there was a report that you might have seen. It came from Reuters, actually, that your administration is readying a package of executive actions aimed at boosting energy supply to power the U.S. expansion of artificial energy. Mr. Secretary, what can you share with us this morning?
Yeah, look, artificial intelligence is an incredibly exciting development that's coming. It is going to revolutionize not just our economy, but our health, drug discovery. But it also plays a huge role in national defense, which is why I've compared it to the Manhattan Project. It's critical, it'll be transformative, and we must lead. We cannot be second place in AI. And to do that, we have the scientists, we have the capital. You have to have a huge growth in U.S. electricity production. So we need to get the morass in the way that's really hobbled the American energy system for the last 4 years. And we got to unleash American investment and American capitalism. That's going to take building a lot of new power generation.
Mr. Secretary, to build on that idea, what type of energy production are you looking at? I know that New York State was just looking at potentially creating a new nuclear energy plant. Is that one of the paths of travel that you think is going to be pivotal for the United States?
Absolutely. Look, to have a secure power grid and to power AI, you need 99.999% of the time on power. And so that today, our biggest source of reliable power today by far is natural gas. Our second biggest source is nuclear, and our third biggest source right behind that is coal. So those are the three keys to the future of our electricity grid. Nuclear, we haven't built much for a while, so I was thrilled to see the governor's announcement embracing nuclear in New York. We have the governors of Tennessee and Georgia and Virginia passionate about getting new nuclear built in their states. So yes, one of our goals in this administration is to launch the American nuclear renaissance.
Mr. Secretary, how do you encourage this type of investment at a time where the goal of the president has also been to lower prices? And we've seen this particularly in the energy space, where the president has been very vocal about the desire to see energy prices lower. And this has led to a number of oil rigs in the shale patch to be taken offline because it isn't profitable for a lot of these companies to be producing as much as they used to. How do you sort of square that circle?
Yes, prices are supply and demand. Prices are supply and demand. But what we're doing in the administration is everything possible to lower the cost to produce energy in the United States. Cheaper to produce a barrel of oil or an MCF of natural gas, or a ton of coal, or a kilowatt hour of electricity from nuclear plants. So that's deregulatory, that's common sense regulation focused on health and safety and the environment, but not the nonsense that just burdens energy producers. Nuclear will be a little bit more expensive at the start, but I think that cost will be borne by hyperscalers. They want to see nuclear re-arrives, and they'll sign higher power purchase agreements to help kickstart nuclear. We need to grow the energy supply and keep costs down. You're right, that's a challenge. You're right to bring that issue up, and that's what I work on 7 days a week.
Let's get at the regulatory burden. We're lucky to have someone in your seat that's actually ran an energy company in this country. As you know, permitting is really difficult across many dimensions. You have to go state by state. Are there things you can do at the executive level to make this a lot easier? Could you describe those kind of things?
There are a number of things, and it is why we created the National Energy Dominance Council. That's really to bring people, leaders from all different agencies that impact the ability to build things in our country together, and say, we talk to producers and say, why aren't you building that? And they'll give us a list of 7 things. It'll take us 7 years, and we're really worried about this one and that one. So we dive into those issues and say, how can we simplify that? But I'll highlight a Supreme Court decision from just a few weeks ago on to get more oil out of Utah via train that had been held up for years through suits over NEPA, and the Supreme Court ruled 8-0. Every Supreme Court justice involved in the case said, yes, we need to put NEPA back in its box. It's to check to make sure the environment's being considered. It's not to have years-long, endless delays. Because if you delay something, you make it more uncertain, more expensive, and simply less things get built.
Mr. Secretary, appreciate your time, sir, as always, to break down the situation. Hopefully we can engage on this conversation again. Chris Wright there, the Energy Secretary of the United States. The big push we're expecting on the regulatory side to make this a whole lot less costlier.
Yeah, and how much do you actually get that to result in some of the plants that he's talking about? That is going to be a real question, and we have already seen some of the hyperscalers make direct investments, as he was talking about, with forward contracts to absorb some of the costs. I do want to see it come to fruition in terms of really understanding what the scope will be.
To Jonathan's point, state by state, it's even more nuanced than that. You have to go local board, by then county board, by then state board to try to get things like a transmission line to go across the United States. And that is why it has been so difficult in the United States.
We talked about the mine. You've got some of the copper deposits here in the United States. Trying to get those mines built takes a long time. Coming up on this program, fresh inflation data. We'll speak to Alejandra Grindal of Ned Davis Research. She's here to react in just a moment. From New York, this is Bloomberg. 60 minutes away from the opening bow, just a few moments away from some breaking economic data here stateside. Into that equity futures, positive by 1/3 on the S&P and up by 0.4% on the Nasdaq 100. Into the bond market we go on a 2-year, 10-year and 30-year. Bond yield shaping up as follows. Yields higher by 2 or 3 basis points to the very front end of the curve. The 2-year 374.80. On 10s at the moment, up 3 basis points at 426.90. With that economic data for you, let's cross over to Mike McKee, who has more. Good morning, Mike.
Good morning, John. Well, personal spending comes in negative, down 0.1%, and that's been a concern for the Fed. Is the economy slowing because consumers are slowing? We saw in yesterday's GDP report that consumer spending had fallen much more than the government had originally reported. Now, on the inflation side, we're pretty much exactly what economists had forecast. They're pretty good at the PCE, 0.1% on the headline number, and 0.2%, a little bit higher inflation on the core. That puts the year-over-year numbers at 2.3% for the headline, up from 2.1%. 2.7% from for the core on a year-over-year basis, up from 2.5%. So if you did want to make the case for a July cut, it gets a little bit harder now because the Fed is further away from its 2% target. And the other number we've got here, personal income, is also a drop, down 0.4%. It rose 0.8% last month. So a lot of give back there. The consumer is cutting back on spending, it appears, and their income, their ability to keep spending, falls in the month of May. So not a particularly good report for the economy overall. The spending and income numbers make a case for the Fed maybe starting to think about cutting. The inflation numbers pushing the other direction.
Mike, we mentioned to you earlier on this morning the difference between the July meeting and the September meeting for the Federal Reserve. You might just sit there and flippantly say just a few months, but you made the point that actually they will have a potentially very different economic picture given they get so much more economic data.
Yeah, we get CPI 3 times before the next Fed meeting. We get 2 more PCE reports. So the Fed will have a much better idea of whether tariffs are feeding into inflation. We get the July CPI on the 5th, or the June CPI on the 15th of July. And that may not capture it all either, but what people will be looking for is specific sectors that might be seeing some inflation pressures from tariffs. And then once we see the reciprocal tariffs and what's going to happen, then you can look at the July and August numbers before you get to the September 17th meeting.
Mike, thanks for the update. Mike McKee there, just breaking down the economic data. Off the back of that data, not a big move in this market right now. At the front end of the curve, yield still higher by 1 or 2 basis points. Similar move at the long end of the curve on a 10-year at the moment, 425.92. If you just wanted to frame the economic data, though, at the moment, you've got this spread between the hard and soft data. Question we've been asking Lisa repeatedly over the last several months. Soft data's down here, depressed, hard data is still robust, resilient. If that spread compresses, if we reconcile things, how do we reconcile things?
And what people are kind of coalescing around is a little bit of both. You could see the top line data come in just a touch, and you are seeing that with downside disappointments from economic data. And you see some of the sentiment improving, which you also see, especially as some of these tail risks are removed. This is a very confusing group of data because you can make the argument they're just the hints, the whiffs of stagflation, but you really can't make any assumptions because it's within the range of where things have been bouncing around.
You do the same thing with the labour market data, a hint of stagnation.
Yeah.
You look at jobless claims, still okay, continuing claims, not very good.
So what do you do with that? What do you do with stagnation, given the fact that people have been saying we're on this tipping point, but it hasn't tipped? And that's the reason why I guess that there are Fed officials that want to wait for more.
Wait a few months and maybe wait until September. Joining us now to have that conversation, Alejandra Grindal of Ned Davis Research. Alejandra, welcome back to the programme. Just frame things from your standpoint. Where's this labour market at right now? Chairman Powell spent hours talking about an economy that was solid. Do you believe it's solid?
You know, of course, solid is a relative call. And again, thank you for having me back again. So the way I would frame the labor market, it's not a super technical term, but I would say it's okay. So we've been seeing signs of softening through a broad array of reports, whether it's the jobless claims, some of the continuing claims data we saw yesterday rose to the highest since 2021. Some weakness in payrolls, more balancing in the labor market from the JOLT survey. But if you look at most of that data, it's still quite far from their recessionary thresholds. So it still gives the Fed some time to sort of sit and wait and see how a lot of, these potential policy changes can impact growth and inflation in the coming months.
Alejandra, can we continue to see this sort of just weakening but not weak trend? When does weakening tip over into weak?
Our base case scenario is kind of, just sort of going about a slower pace of growth, not necessarily recession, which is, I think, of what you meant by weak. Ultimately, the main thing to watch is the labor market. So we've kind of had these slowdowns in growth over the past few years, some upticks, but we haven't fallen into that recession territory really because of that resiliency in the labor market. So that's why we're watching it so closely. I don't know. Our base case is that we kind of muddle through with about the same, sort of this slowing in growth, but still away from recessionary thresholds. But again, it's very dependent on policy. If most of the downside risks come into fruition, whether it comes through tariffs or higher inflation and increased uncertainty, we could see pronounced weakness in the labor market. If the tariffs sort of settle at a more reasonable level, we get the big, beautiful bill with tax cuts and some expansionary policy, then that could sort of keep the labor market from falling over the edge. So just in general, a lot of uncertainty, pretty much what you guys were mentioning earlier.
Which is what everyone's been talking about. We have a week until that July 4th self-imposed deadline for the one big, beautiful bill where no one's going to be going on vacation, ostensibly, because John canceled it or Annmarie canceled it earlier. But there is this question going forward about how much the economic outlook could change, not only with a week from now, that July 4th deadline, but also July 9th. How big is the sort of range of scenarios for you?
Well, again, the base case and the highest probability of more than 50% is just slowing growth and then either stable or slightly higher inflation. So kind of what you guys mentioned before, that stagflation light. But there are some tail risks that you could maybe see things get extraordinarily better, right? Let's just say we do miraculously get these 90 deals in 90 days within the next couple of weeks, or less than that, actually, within 1 week. We get the big, beautiful bill. That could be, maybe a tail positive upside surprise, but I think it's a lesser likely scenario. And then I talked before about the potential recessionary scenario, but I do think that's lower as well. So yeah, base case, actually very in line with what the Fed has said, is a slowdown in growth below potential, but still positive, and slightly higher inflation.
Well, you have individuals who are saying, like Michael Hartnett this morning, a pivot from tariff to tax cuts, rate cuts could lead to high risk of a bubble in the second half of the year. But you think the second half of the year is still going to be talking about policy uncertainty in Washington, D.C.?
Yeah, I do think part of it is I don't think these tariff deals are going to be done that quickly. So there's still going to be some back and forth and some uncertainty. We should have a little more uncertainty from the big, beautiful bill. I would suspect that's probably going to get approved at least over the next month or so, or we get some closure there. But I do think the tariff uncertainty will continue. And the impact it's going to have on inflation will take some time. So I think we'll be watching the data. And then there's also a lot of other policies that have happened since the beginning of the year. We had the DOGE cuts at the beginning of the year that could have reciprocal impacts on state and local governments, what we started seeing at the federal level. And then also the immigration policies. What are they going to do to the labor force? What are they going to do to growth? So it's not just those tariffs and big, beautiful bill, but there's a lot of other things going on that may just have more of a delayed ripple effect as the year progresses and just contributing to uncertainty.
How quickly do we need to get to some clarity on all these issues for the U.S. to maintain this exceptionalism?
Well, exceptionalism, the way I describe it, is just the fact, especially compared to the rest of the developed world, we just have the potential to grow so much faster. And it's pretty much just based on two things. We have generally faster labor force growth. We have faster productivity growth. And over short periods of time, it's really hard to see the effect, say the long-term effect on the long-term growth of those items. But if we were to see a huge reduction in our labor force because of maybe some of the immigration policy, some of the early retirement we've been seeing, that could create a downside risk to long-term U.S. exceptionalism and growth. And then, of course, tariffs, right? Holding all else constant, tariffs reduce competitiveness. They reduce the gains from comparative advantage and could reduce that strong productivity the U.S. has. On the other hand, we're also just generally more productive than a lot of the developed world because we're less regulated. We have more fluid labor markets. We have lower taxes. Big, beautiful bill will probably contribute to that as well. We're also energy independent. So there's a lot of things that still work in our favor, but there's a few policy items that could whittle down some of that advantage that we've had for several years now.
Every time I see you, I want to move to the suburbs. Every single time. I want that grill. I want that terrace.
The trees in the back. I think she should run Architectural Digest.
We're moving to Florida.
Yeah.
Oh, gosh, stop.
Seriously,
Let's
it's
make
always
this
beautiful.
happen.
It's like perfect.
We're moving to Florida.
We're moving to
Alejandra Grindal of Ned Davis Research will be our first on-set guest.
Totally.
Pick a city.
You actually
Where do you wanna
invented
be?
Governor Hochul said this, that I can't think about raising taxes because I can't lose any more people to Palm Beach. That's what she said this week.
We don't want Governor Hochul to come with us. We're moving to Florida.
All I can say is you really want the weather that we got earlier this week. That's all I can say.
I don't mind the weather.
Are you kidding?
I carry the weather.
Earlier this week?
Good aircon down there, haven't they?
Okay, yes, but if you want to go outside.
Get up
that's
early.
Suffocating. Nobody.
We get up early, don't we?
I mean, so then you just you don't go outside. You just hide in a closet.
Get
That's
up early. Who says we're hiding in the closet?
Go to the beach.
I don't think you think that's what they do in Florida?
We're going
Just hiding
paddleboarding.
in closets.
We're getting a boat.
My goodness, Bramo. What are you doing this morning? Mike McKee's back with us now to break down this economic data. Mike, you've had a second look. What do you see?
Well, there's some interesting detail underneath everything, John. In the personal income category, wages are hanging in there. They were up 0.4%, so no real problem for Americans who are spending what they earn. We had a big drop in farm payments, about 50% over the month, and a drop in Social Security payments, 7.3%. So it looks like this isn't as bad a number as it would appear on the surface. Spending numbers were kind of interesting. We had a big decline in goods spending, particularly on durable goods, down 1.8%, while services spending rose an anemic 0.14%. So you can see that Americans backed off in both areas. So the final number I would throw at you is the savings rate falls to 4.5% from 4.9%. So even if wages are hanging in there, it looks like people spent down a little bit of their savings to even do the meager spending that they did.
Mike McKee, appreciate the update. Thank you, Mike. Have a good weekend. Mike McKee there breaking down the economic data for you. Lisa, it feels like we're going into July without this debate changing much over the last 2 months. Economists haven't really changed their course on much at all. Market participants have. Market participants have because things have de-escalated in such a material way across so many different things.
How do you price in tail risks that could potentially totally upend the modern order of trade and the modern order of the U.S. economy, where people are questioning U.S. exceptionalism? People really struggled with it. And now we're back to a place of just actually looking at the economic data and the sort of muddle-through economy that we've been dealing with. The real sort of overlay here is the fact that profit margins for the big tech companies have come in so big that they have eradicated a lot of fears. And frankly, the narrow breadth in the market has been a boon, because if you can keep betting on that, that will keep driving you forward. And that is the belief right now, at least in markets.
The S&P is at an all-time high. Only 22 participants are also at all-time highs, according to Michael Harnett, according to him, over at Bank of America. But they're the right 22, which is why we're at a record, because they have such a heavy weighting on the S&P.
The stock market is not the economy. And maybe that's a good thing.
You've said that repeatedly.
And that's what people are looking at.
And you're absolutely right. We'll get another read on the economy later on at 10 a.m. Eastern Time, when we get a read on consumer confidence, consumer sentiment with the UMich survey. Is it an economic survey or just a political poll? We'll have that debate again at 10 a.m. Eastern Time if you want to tune in for that. And then next week, it's Payrolls Thursday, not Payrolls Friday. Just want to throw that out there once more. Let's give an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahira. Hey, Yahira.
Hi, John. We start with a recap on all that economic data. The Fed's preferred measure of inflation rose in May. Core PCE increased at 0.2% from April, slightly higher than estimates calling for 0.1%. At the same time, consumer spending declined by the most since the start of the year, indicating uncertainty around the Trump administration's economic policies are weighing on growth. Meanwhile, Andrew Cuomo is not quitting the New York City mayor's race. Sources telling us here at Bloomberg he'll appear on the ballot in November as an independent, despite pressure from donors and advisors to drop out. It comes after Cuomo's stunning defeat in the first round of the Democratic primary by the Democratic socialist Zohran Mamdani. And Anna Wintour is stepping down from her role as editor-in-chief of American Vogue after 37 years. The magazine is seeking a new head of American editorial content, a newly created position that will be responsible for daily editing duties. Wintour will continue to work for Condé Nast, overseeing all of its global brands and likely still going to all those sporting events. That's your Bloomberg Brief. John?
Yahira, thank you. Have a wonderful weekend. Bramo's got thoughts.
No, I just
It's a vacancy you could fill. I could see that.
Are you kidding? I am the least person. I'm not a stay on my opinion. I don't think anyone would confuse that.
Change everything.
Yeah.
Change style.
Let's just wear paper bags. No, I'm kidding. I'm just saying. I don't
hide in closets, apparently, if you live in Florida.
Closets. I don't think anyone wants to see me in the charge of fashion.
Do you want to explain that?
No, I don't, actually.
Got a very faithful audience down in Florida.
The truth is, it gets very hot.
Okay.
And so, do you go outside and be on a boat? If you do happen to burn very easily, do you just hide in a closet?
Oh, right, okay.
50%.
A sunscreen issue.
Yeah, we really don't need to be having this conversation.
We can do this later. All right. Up next, let's set you up for the day ahead. We'll catch up with Gennadiy Goldberg of TD Securities. Plus, Danny Berger with your morning movers as Nike jumps following earnings. That stock is up by 11% in the pre-market. Our next guest suggesting Bloomberg yacht. I don't know if that's the show and the studio.
Yeah.
Just have a yacht there.
You guys will all be outside tanning and I'll be in a closet.
Sounds amazing. We don't want you in a closet. Get some aircon going for you, okay? Equities at the moment on the S&P up by 1/3% on the S&P 500. The opening bell about 42 minutes away. Let's get you some morning moves and cross over to Danny Berger, who has more. Hey, Danny.
Hey, John. Nike continues to be the dominant stock in the pre-market trade. After reporting earnings after the bell yesterday, shares are up more than 11%. They forecast for the current quarter a smaller loss than expected, and it's given the street confidence that the worst is in for Nike, that the bottom is in, and we rebound from here, that the new CEO has put in enough measures to focus on things like sports and to help with some of the inventory issues. So that rallying in the pre-market. Also higher in the pre-market is Boeing. This after an upgrade from Rothschilds & Co. Redburn, saying that it is now a turnaround that looks complete. In other words, they're going to start to be able to meet expectations. The analysts, they are calling it a new phase for Boeing. Those shares up just under 1%. Finally, wrapping it up with a bunch of the energy companies listed in the U.S. This after a Reuters report that the Trump administration is looking at signing an executive order that would make it easier for energy companies to supply energy to AI. That's things like connecting into the grid, making use of federal land to build data centers. So Constellation Energy leading the pack this morning. Those shares up 2% in the pre-market, John.
Danny, thank you. Great work as always. Enjoy the weekend. The Energy Secretary, Chris Wright, was on with us moments ago, about 30 minutes ago. We asked him about that story. Didn't confirm it, but gave a little nod to the existence of that maybe happening in the future.
Definitely the direction of travel, because he's also been talking about this for months. This idea of deregulation is needed in this environment, and you're going to need more energy and power to support the AI industry.
Energy elsewhere, Brent crude positive by 0.4% this morning. What a ride all has been. Just think about it. We came into Monday talking about crude maybe going into triple digits after the move over the weekend, and then we wake up to what, 50s, 60s all over again?
You wonder why we're numb. This is the reason why.
Totally benumbed. That's a word you used earlier this week. It's so true.
It just feels like, one dramatic headline, you just wait 5 minutes and it'll disappear.
We've moved on quickly. Very quickly, as we count you down to the opening bell, a few things to get through before you get to the weekend at 10 a.m. Eastern Time. UMich Consumer Sentiment. Next week, looking ahead to next week, a sneak peek, JOLTS, job openings and ISM manufacturing. Next week on Tuesday, on Wednesday, ADP payrolls. Thursday, the June payrolls report. Before Friday, remember the deadline for the tax bill. Self-imposed, could move, so we'll see what happens next week. Turning back to the economic data, moments ago, core PCE increasing 0.2% from April, slightly higher than estimated. Joining us around the table, Gennadiy Goldberg of TD Securities. Gennadiy, good to see you, sir. Good morning.
Thanks for having me.
Let's not just talk about the data, let's talk about the move we've seen at the front end of the curve so far this week. Two-year yields have really moved back. Are you starting to see a spread emerge between what people are pricing in and what the core of the FOMC is actually telling us about the future Fed path?
Yeah, a little bit. I think there's a little bit of almost an over-optimism that rate cuts are coming imminently. Most of that is driven by Governor Waller and Governor Bowman basically referencing that July is in play. I think the rest of the FOMC, a lot of the Fed speakers who have come after that have basically said, look, maybe not that early. We'll see it over the next couple of months. There's really two camps emerging. It's the two-cut camp and the no-cut camp. And Governor Bowman and Waller are both in the three-cut camp, most likely on their dots. So they're the most dovish members of the FOMC. And I think they're really shifting the pricing probably a little bit too much, too fast. But I still think there are cuts later this year.
On inflation, you've got the temporary camp. And then you've got the I don't know camp, which seems to describe the Federal Reserve as well. But this market has decisively concluded this is the temporary story.
Right.
How much do you see that through fixed income at the moment, that they're just fading this inflation story entirely?
It's been that way the entire time. I don't think there's ever been a point, or at least in the last 6 months, where the markets assume that this is a permanent level shock higher. If you look at short-term inflation swaps, one-year inflation swaps are still pricing in a shock. 2-year inflation swaps are pricing in less of a shock. By the time you get out to 3 and 4 years, it's basically gone. The market is basically assuming that this is a one-time trick, and it's not going to persist into the future.
Then why are 10-year yields still at 4.25%?
I think there's just a lot of uncertainty about when the Fed goes. You still have to wait for the Fed to actually take rates a little bit lower. You still have to wait for something to get a little bit softer on the economic data side. And if, let's say, inflation is a one-time shock, but it's still relatively contained, growth is doing okay. I think that's a good way to describe it. With a marginal slowing over time, there's not really an impetus for the Fed to cut rates sharply. So you're going to have these persistently higher rates for longer. I think it's going to be more of a drift lower in rates. That's why our year-end forecast is 4% for 10s, not a 3%.
In this year's narrative whiplash, we've been talking about the potential for the economy to weaken, and we've been also talking about the ramifications of the U.S. deficit when it comes to where long-term yields are. We are going to see this deadline approached for July 4th in a week. I'm just curious, especially as some of the offsets to any spending get removed, how much that's going to come back into play for the bond market in a very real way.
You know what's interesting? I haven't heard a lot about the deficit just in the last couple of weeks. It feels like the story's completely died down.
What's up with that?
Everyone was talking about deficits. I would say over a longer period of time, deficits versus macro is about 10% and 90%. Markets move on 90% macro. We were all focused on that 10%. And we were pounding the table basically saying, look, if it looks like the macro is going to be back in the driver's seat, the market is going to ignore deficits for a little while. Now that we've got term premium higher, and by the way, that hasn't gone away. Term premium is still very much elevated. But I think the market is looking around and saying, 60, 70 basis points of term premium in the 10-year, maybe that's enough for the longer term, and that could persist for a longer period of time. And you could still see yields going lower with that higher term premium in tow. So it's now a larger portion of the overall yield.
Is the market breathing a sigh of relief from the Treasury Secretary announcing the removal of Section 899?
I think so. I think between that and some of the SLR changes that happened at the Fed or that were proposed by the Fed on Wednesday, that's definitely helping to improve sentiment. You're seeing swap spreads actually widen out. So you're definitely seeing that Section 899 proposed removal of the proposal. I don't even know how to describe that anymore. But I think the fact that you're seeing that maybe stripped out of the bill be kind of a positive step in the right direction, where we're not going to, weaponize financial markets.
Before you go, first cut, when?
We think October. I think by that point you'll see enough on the inflation side to know that it's more likely than not a transitory, dare I say the word, or temporary spike in inflation. And by that point, you should see enough weakness accumulate also on the labor market and the economy as a whole. They'll feel a little bit more comfortable.
Yeah, this stands out from you and the team. You seem to think that growth slowdown is really going to pick up as the year matures, grows older.
It's more of a gradual slowdown. You kind of see it in the labor market side as well. You've seen payroll growth continue to gradually moderate over the last 3 to 6 months. We expect more of that. You're seeing that in the personal income and spending numbers. Yep. They are going to start to slow down. Remember, we've gotten a lot of front loading before on the trade side. Now we're seeing the impact of that. Consumers are buying less because they've already bought everything. The trade is going to translate into higher prices. I was just looking at how much we've collected in tariff revenue. It's been $70 billion in the last 3 months. The baseline run rate ahead of this was about 20.
I
so
got
it's an extra 50.
Will you join us in Florida?
Absolutely.
Happy to. Good. All right. Gennadiy Goldberg there of TD Securities. That does it for us. Thank you very much for choosing Bloomberg TV. On Monday, the lineup looks like this. Stuart Kaiser of Citi, Kurt Ryman of UBS, the former Kansas City Fed President Esther George, Michael Kushner of Morgan Stanley. Have a wonderful weekend. This was Bloomberg Surveillance.